Heavenly Father, we thank you for this hour. We thank you for this day. Your children has gathered this morning to come and share knowledge and experience. We invite the Holy Spirit to come and take control. May the good Lord be present in the name of Jesus. Whatever we are going to discuss today, Lord, let it be to our glory and to the goodness of ourselves and the nation. These and other intentions we ask through Jesus Christ our Lord. Amen. In the name of the Father and of the Holy Spirit.
Amen. Thank you very much,
Amen.
Mr. Jacob. Thank you. Amen. Next, we'll take the welcome address by the President. President, you have the digital podium.
All right. Hello, good morning, distinguished participants. Hello, good morning, distinguished participants.
Good morning.
Good morning.
Very
Good
much.
morning,
Thank
Mr.
you very
President.
much.
Good
Thank you very
morning,
much, sir.
Laika.
I'm
Professor.
yes, sir. I'm the DG representing Dame Silva Taiwo Ige, the president of this prestigious association, right? And the one of the things we want to do today, we don't want to waste people's time because honestly, to come here at this kind of hour during the day, the first working day of the month, we need to really cut a lot of things. So, we should believe that with caliber of people that are going to make presentation today, ably FCS, that we are going to have a wonderful session. And so that's it.
Is it from my own end or is from everybody's?
Open
We are not
by
hearing
Financial
very well.
Regulation Week, and this is today, right?
The network is not so good at his hand. So just manage it. Yes.
Okay.
What is the importance of Basel? Basel meet up with the NIB, they'll be able to meet up. How are they ready?
We are not hearing.
No, I think it's cut off.
Yeah,
It's cut off.
The network has disconnected.
I think the network.
We'll just wait for him to rejoin the session.
Yes,
so
please.
Whilst you're waiting for him to rejoin the session, I want to give a bit of background around the Basel conversation. So the theme for this conference, so this is the Basel Accord Day conference, and the theme is Basel at Crossroads, from Basel I to Basel III finalization. Can capital regulation catch up with the emerging risks? And the background to this conversation is such that the global financial system continues to evolve. And the Basel Committee on Banking Supervision has over the decades introduced Basel I, Basel II, and Basel III. And the intent is to strengthen capital adequacy, improve risk management practices, enhance the financial system resilience. And the finalization of the Basel III for us is a significant milestone in the global banking regulation. And however, we have questions around the ability of capital regulation to keep pace with this rapidly evolving risk landscape. So this session is meant to welcome participants in the risk conversation to foster engagement around strengthening financial resilience and regulatory excellence, have us share knowledge, collaborate amongst ourselves as stakeholders, and to also check whether existing regulatory frameworks is adequate enough to address the emerging threats to financial stability. So these are the conversations we'll be having throughout today, and I'm hoping that we'll all be actively engaged and contribute to the conversation. I'll just pause take reactions.
Thank you very much, Tosin, for summarizing today's discussion for our esteemed members and of this distinguished association. I believe Tosin have summarized, so if there's any observation on the agenda and the plans of today for anybody to add or make comment before we got the president back, I think the floor is open so that at least Tosin can be able to respond to some of the things if there is any clarification or amendment that we need to do based on today's plans.
Okay, thank you very much, sir. Yes, I think at this point, I need to introduce myself. My name is Sir Jacob Ipoga. I am the Chief Executive Officer of Continental Economic Magazine. I want to request that this conversation, if it can be recorded and transferred to me for publication, because I know it's going to be a robust discussion and many people outside would like to benefit from it. So I won't mind offering my paper to do the publication. Thank you.
Thank you very much, sir. Thank you. The session is being recorded, and we will then engage with you after this session in terms of how you can then get the recording. But I can confirm that it's been recorded.
Thank you.
And I believe there is even going to be a communique at the end of the day. I think that one will go a long way so that we can provide that to Jacob as soon as possible. Jacob, we appreciate this offer you have done for us. And we believe you are a partner in progress, and I believe that will go a long way. I think Tasiu is raising his hand. Tasiu Suleiman Tijani, please.
Okay, good morning, good afternoon, sir, and thank you for giving me this opportunity. I became very excited and also glad to have seen the Serikin Fulani of Gombe to be part of this conversation. You were once a board member when I was working with Jais Bank, and I want to believe that we'll learn a lot from your expertise, most importantly from the current trend that is happening in the Nigerian, stock exchange market and, Securities and Exchange Commission. So it's good to have you, sir. Thank you once again.
Thank you. Thank you very much, as we appreciate. I believe at the end of the day, we are all together. Whatever we can be able to do to boost our capital market, the financial system, and the economy in general is our responsibility. And with the caliber of people I've seen here today, I believe it's going to be a robust discussion. And that will go a long way, at least, to come up with a communique that can be able to add value and make suggestions, both in the private and the public sector. Thank you very much, Tasiu.
Thank you very much, sir. We will now take your welcome address. We'll take the welcome address by the chairman, Alhaji Dr. Umar Kaiwaringa. Thank you very much.
Thank you very much, Tosi. Let me first of all appreciate the number of people I've seen that have already joined for this conference. This has demonstrated the interest that we have for our institution and the economy in general. So, distinguished regulators that are here, policy makers, industry leaders, members of the financial services community, esteemed speakers, ladies and gentlemen, good afternoon. It is my honor and privilege to chair this year's Global Financial Regulation Week and Basel Accord Day Conference. I commend the Association of Enterprise Risk Management Professionals for sustaining this important platform for dialogue on one of the most consequential issues facing the global financial system today. Financial regulation has entered a defining moment. For decades, the conversation around regulation centered largely on ensuring institutional safety, strengthening capital adequacy, and preventing systematic risks. Today, however, regulators face a far broader and more complex mandate. We are now called upon to regulate markets that operate at digital speeds, oversee technologies that evolve faster than policy cycles, manage risks that transcend borders, and preserve trust in an increasingly interconnected global financial system. The reality is that the risk landscape has fundamentally changed. Artificial intelligence is reshaping financial services. Climate change is redefining long-term financial resilience. Cyber threats continue to evolve in sophistication. Digital assets and tokenized finance are challenging conventional market structures. Fintech innovation continues to redefine customer expectations, while geopolitical uncertainties increasingly influence capital flows across all jurisdictions. The Basel I to Basel III finalization have evolved from focusing largely on credit risks to market and operational risks, to more specific measures in respect of capital quality, liquidity, standard, leverage, and capital buffers. The regulations have no doubt helped to strengthen the stability of the financial system. Against this backdrop, the question before us is no longer whether regulation should evolve. Rather, it is whether regulation can evolve quickly enough to remain effective without stifling innovation. That is why this year's theme is particularly significant. The Basel Framework represents one of the most influential regulatory achievements in modern financial history. Yet every regulatory framework is ultimately tested not by the crisis it was designed to solve, but by the risks it did not anticipate. This is precisely why today's conversation matters a lot. While the Basel Framework originated within banking supervision, the broader principles it embodies, resilience, transparency, sound governance, and effective risk management, have become equally relevant across the wider financial ecosystem, including our capital markets. At Nigeria Exchange, we witness the delicate balance between fostering innovation and maintaining market confidence. Capital markets flourish where trust exists. Trust is created through transparency, and transparency is sustained through effective governance, and governance is strengthened by credible, forward-looking regulation. These are not competing objectives, but are mutually reinforcing pillars of sustainable market development. As an exchange continues to evolve from traditional trading venues into technology-enabled market infrastructure providers, regulators must equally evolve from rule enforcers into strategic partners in market development. Across Africa, we have a unique opportunity to build financial systems that are not constrained by legacy structures, but are designed for the realities of the 21st century. The continent's growing population, increasing digital adoption, and expanding investment opportunities present enormous potential for us. Realizing that potential, however, requires a regulatory system that inspires investor confidence, facilitates efficient capital formation, and encouraging responsible innovation. At MDX, we have consistently pursued initiatives that demonstrate this balance, whether through advancing market digitalization, introducing innovative products, strengthening market infrastructure, promoting sustainable finance, or deepening investor participation. Our objective has remained consistent: to build markets that are efficient, transparent, resilient, and globally competitive. No regulator or exchange or any financial institution or jurisdiction can independently address the challenges posed by artificial intelligence, cyber risks, climate finance, or increasingly interconnected financial systems. The next chapter of financial regulation will be defined less by individual institutions and more by collective intelligence. Forums such as this therefore become indispensable. They provide opportunities for regulators, market operators, policymakers, academics, and industry practitioners to exchange ideas, challenge assumptions, and collectively shape regulatory approaches that are proportionate, adaptive, and forward-looking. As we engage throughout today's sections, I encourage us to think beyond compliance. Let us consider how regulation can become a strategic enabler of sustainable economic development, and examine how international standards can be effectively adopted to local market realities without compromising global credibility. Most importantly, let us ask ourselves whether the institution we are building today will remain fit for purpose in the financial landscape of tomorrow. I have every confidence that the insights shared during this conference will contribute meaningfully to that objective. Once again, I congratulate the Association of Enterprise Risk Management Professionals for convening this important gathering, and thank all our distinguished speakers and participants for lending their expertise to this timely conversation. I wish the association a very successful conference and look forward to an in-depth deliberations on key matters at this conference and a concise communique that will provide appropriate steps that key stakeholders need to take to ensure the maintenance of financial system stability. Thank you very much for listening and wish us a successful conference. Thank you, Tosi.
Thank you. Thank you very much, Mr. Chair. Thank you very much for that amazing delivery. It is very inspiring and it sets the tone, the right tone for us to take reactions. So the floor is open. Let's react. Let's express our digital applause is coming through. Let's express our reactions to the amazing speech by Mr. Chair. Any reactions in the room?
I've seen Elijah raising his hand. I can see it is Hafsa that I've just joined now. Elijah? Kolawole Adeboye. Maybe we have more than one Elijah. Let me see when I call Tosi, I say Tosi Leye Odeyemi, so that will be specific.
Thank you very much for that speech, sir. You're very correct. This is the time for us to have this conversation. The time is now. Thank you very, very much now. We will then move quickly to taking the goodwill message. We have with us the 17th president of the Chartered Institute of Taxation of Nigeria, Dr. Innocent Ohagwa. We would love to take your goodwill message at this time. Dr. Innocent, thank you, sir.
Good morning, very distinguished ladies and gentlemen. I recognize the president of this great body, the chairman of the occasion, the regulators present, esteemed leaders and members of the association, practitioners, professional colleagues, ladies and gentlemen. Good morning once again. I extend warm greetings from the Governing Council and the entire membership of Chartered Institute of Taxation of Nigeria. It is truly a profound honor to serve as the special guest of honor at the Global Financial Regulation Week of 2026 and the Basel Accord Day Conference. I wish to sincerely commend and congratulate the leadership of the Association of Enterprise Risk Management Professionals for convening this remarkable flagship initiative that brings together regulators, financial institutions, risk professionals, academics, stakeholders, and thought leaders from across the globe. This is no small feat. It is a profound service to the nation and to the global community. The chosen theme, Basel at a crossroad, from Basel I to III, finalization, can capital regulation catch up with emerging risk, is both timely and thought-provoking. Over the past 4 decades, the Basel Accords have fundamentally reshaped global banking regulation by strengthening capital adequacy, promoting sound risk management, and enhancing financial resilience. However, the journey from Basel I to the finalization of Basel III demonstrates that regulation is not static, it's a continuous process and adaptation to emerging realities. One of the enduring strengths of the Basel framework is the recognition of that risk within the financial system seldom remain confined to financial institutions alone, whether arising from excessive leverage, liquidity pressures, cyber threats, climate-related financial exposures, digital disruption, among others. These emerging risks have profound implications for the wider economy. A resilient financial sector is indispensable to fiscal and economic development because it directly influences the cost and availability of credit. interest rate movement, business profitability, investment decisions, and overall economic growth. These in turn determine the size and sustainability of the tax base, government revenues, and the capacity of the state to finance public services. It follows, therefore, distinguished ladies and gentlemen, that the financial stability and tax system effectively are mutually reinforcing objectives. In Nigeria, the recent tax reforms represents an important implement to broader financial sector reforms. By modernizing tax administration, simplifying compliance, broadening the tax base, strengthening revenue assurance, ensuring transparency, and providing greater certainty for businesses and investors, the tax reform contributes to mitigating fiscal risk that could otherwise undermine macroeconomic stability. In this sense, they form part of a wider governance architecture that promotes resilience against emerging risk. As a professional tax institute, Chartered Institute of Taxation of Nigeria recognizes the critical intersection between taxation, fiscal regulation, and economic stability, just as the Basel Framework provides standards for identifying and measuring managing risk within financial system. The current tax reform strengthens the fiscal framework by safeguarding public revenues, encouraging investment, improving voluntary compliance, and reinforcing economic resilience necessary for sustainable development. This interdependence underscores the importance of continued collaboration among financial regulators, tax authorities, professionals, policymakers, and enterprise risk professionals in building economies that are not only stable, but also adaptive to an increasingly complex and uncertain global environment. Let me acknowledge the spirit of partnership between Chartered Institute of Taxation Nigeria and the association. In many ways, taxation and risk management share the same DNA. Both are about building resilience. Taxation provides the fiscal muscle for government to act, while risk management provides the framework that prevents small shocks from becoming systemic crises. Today, they serve as the scaffolding of stability and prosperity. Finally, on behalf of the Council of the CITN, I commend this great association for convening this global platform and look forward to the rich insights and collaborative solutions that this will emerge. Please accept our warmest goodwill and best wishes for fruitful deliberations. Once again, I thank you for the honor of this invitation. Thank you, and God bless you all. Amen.
Amen. Thank you very
Amen.
much, sir. Thank you very much for the good message, sir. And indeed, this is a symbiotic relationship, and we continue to work together towards our agreed goal. Thank you very much, sir.
Let me join Tosin to appreciate your innocence. I think we are partners in progress, just like the way you have said it. So many things in common between your own association and that of the AERMP. And we appreciate this fruitful paper that you have done, and that have demonstrated the type of relationship we have in the financial sector generally. Well done, Innocent.
Thank you, sir. Thank you.
Thank you very much, Mr. Chair. Thank you, Mr. Chair. Thank you. If there are no reactions in the chat room or on the meeting, we're expecting the President of the Institute of Chartered Secretaries and Administrators of Nigeria, ICSAN, Mrs. Uto Kupana, FCIS. Just checking if she's in the room so we can also take her good message. Let's check if she's here.
Omomi.
Don't see her in the room, so maybe when she joins us, she can then give us a goodwill message.
Oh, okay, Tos.
Yes, we don't see her. Okay, yeah, she's here now. She's here now. Mrs. Upana, you have the floor for your goodwill message, ma. All right, maybe networking. Maybe there are network challenges. Okay. So if there are no reactions to the goodwill message and the keynote address from our Mr. Chair, Mr. Chair, we're expecting August visitors from the Central Bank of Nigeria. Just checking if they're in the room for the first keynote address. Okay, we know it's a working day, so we know there'll be challenges around calendars.
Yes, thanks so much, Madam Tosin. The president of ICSAN, she has actually communicated. Oh, she's here now. Thank you.
Good afternoon. I just checking that you can hear me.
Yes, we can hear you, ma.
Thank you very much. An apology, as I said, although this was a short notice, I had to honor the invitation. So please forgive me for joining a little bit later than I thought I did.
We appreciate your time, ma. We appreciate your time, ma. Thank you for joining.
Okay. I'll just proceed with my message. I just want to say that on behalf of the Governing Council and members of the Institute of Chartered Secretaries and Administrators of Nigeria, I wish to congratulate the Association of Enterprise Risk Management Professionals on the 2026 Global Financial Regulation FinReg Group, and of course the Basel Accord conference. This is very important, especially important conference, and I believe that it will also present an opportunity for deep dive discussion and dialogue on the global banking with capital requirements, and of course enterprise risk management and compliance. At ICSAN, we are very, very glad that this engagement is going on. And it is core to land governance, which we at ICSAN are foundational in promoting. I also, before I end, I would like to say that ICSAN and your association, we will explore ways in which we can continue this conversation beyond today and also explore other areas of collaboration. Once again, I wish you very productive and fruitful engagement and conversation and interaction. Once again, thank you for this opportunity. Thank you.
Thank you very much, ma'am. Thank you. Yeah, thank you very much for the goodwill message, ma'am. Totally agree with your submission, ma'am. So the floor is open. Let's react to the goodwill messages. This is an interactive session, so please let's react. Let's react. Thank you very much, ma, for the message.
So well, thank you for having me.
Thank you very much.
Well done, my sister.
Thank you very much.
Well done. Thank you. Thank you. Thank you.
Reactions. Let's express our appreciation. Let's express our feedback. Reactions to the we've had two goodwill messages so far, and we've also had our opening speech from our chairman. Any reactions? The chat room should also be buzzing. Let's also use the chat room as much as possible. Let's to express our reactions. And also on the topic of today, the theme for the session is Basel at a crossroads, from Basel I to Basel III finalization. Can capital regulation catch up with emerging risks? Where do we believe that this conversation is currently at? The existing regulatory frameworks that we have in place, are they adequate to address contemporary and emerging threats to financial stability? Let's use the chat room to express our opinion around this conversation. Do the existing regulatory frameworks, do they suffice? Are they adequate to ensure that we're able to deal with the Basel III finalization and also catch up with the emerging risks as we see it, to ensure financial resilience? And also, AI is also critical to the conversation in our new world. Cyber risk is also very topical. Fintech disruption is there, digital finance is there, climate change is also there. We've been having rains over the last couple of days. All of this threaten financial resilience. Do we have enough existing regulatory frameworks in place to address these emerging threats to financial stability? It will be great to hear opinion in the chat room to understand where it is we need to take this conversation further. This is meant to be an interactive session. Let's put our thoughts in the chat room. Let's react to the goodwill messages that we've heard thus far. Let's also react to the charge from our chair at the start of today's session. Let's put our thoughts in the chat room.
Because we can't get the president even on the line to come back, so he couldn't join. Tosi.
Yes, sir, I can hear you, sir. So the GG is on the meeting, but he's making some arrangements on the back end. But we have some visitors with us. Tan May, we have you in the room with us. Tan May.
Hello everyone. Yeah.
Hello.
You can hear me?
Get your reaction. Yes, we can hear you.
Sure. Should I start presenting?
Yes, please. You can start your presentation, sir.
Sure. Thank you. Thank you so much. First of all, I think I'm visible now.
Yes, you are.
Yes.
Thank you. Yeah. Thank you. Thank you so much. So, first of all, I just wanted to say good afternoon, good morning to Mr. Chairman, distinguished risk professionals. I'm sure that there are multiple people from Central Bank is also present. So a very warm welcome to you. Good afternoon to speakers, presenters, association members, of course, moderator, and my dear participants. First of all, thank you for inviting me here. And the best part is to listen to a very well chosen topic on the eve of Basel Accord Day, and also to present a topic on the fintech, digital assets, and regulatory innovations. So let me just share my presentation if I'm allowed to. Let me just share it. Please let me know if you are able to see the presentation. Is it visible?
Yes, please.
Yeah. Thank you so much. So this is me. I'm the founder and CEO of Septoros Private Limited from India. I have worked in Oracle Financial Services and also in Boeing. So I have a knowledge of both the financial services as well as the aerospace technologies. I have worked on 5+ years in emerging technologies as part of my previous tenure in Boeing, as well as into my own company. So I am an expert into anti-money laundering and financial crime. We have been designing solutions and systems to make sure that we comply with the regulatory and make sure that none of the banks are left out. So I am PMP, CISSP, emerging technology expert, and IEEE speaker as well. So what we do is we design products on enterprise AML suits, risk modeling, asset and liability management, reconciliation suits, and enterprise data ETL and unification. So this was my introduction, and the hot topic which we see today is digital assets, right? So and most of you would be thinking digital assets as Bitcoin, and you're not wrong. I think you are in the right path. Yes, it's Bitcoins, but Bitcoin is not the only thing which is of an essence at today's world, right? So anything of value that exists in a digital format is called a digital asset. Now, like Mr. Chairman was speaking about cybersecurity threats and multiple market risk factors, there are threats related to digital frauds as well. So there are multiple paradigms where the digital frauds can happen, right? We can start with the digital contracts, customer records, and everything you deal with it daily, right? So as risk professionals, we do deal with the risks daily, right? So your customer records, your interactions with the customer, your talks with the customer, licenses, cloud documents, digital certificates, everything comes under digital assets. There are topics around how do we secure it, how do we fulfill it, how do you make it secured, and all those. But I will take you through a different perspective today, where we want to understand how the regulator is looking at it, and where exactly the criminals are also looking at it, right? How can we help using innovations? How can we help using people? How can we help using a singular structure where we all work together, right? So digital assets is the assets which is available to us, but what is making the criminals die for it is the virtual assets, right? So you all know that the virtual assets, or which is also called as virtual digital assets, are those kind of assets which can be transferred in nature. It can be bought, sold, invested in digital form only, right? Um, if you look at the properties of a virtual assets, they basically use a blockchain ledger, right? Now, what is a blockchain? I will not go too deep into it. It's a technology. It's a technology which has started from the paper by Satoshi Nakamoto, okay, in 2008, October 2008. And he has invented the blockchain as a technology part, where we are able to transfer the assets in digital form using proof of work, right? After that, there are multiple other inventions around it, and we have publicly available blockchains, we have privately available blockchains. There are numerous privately available blockchains, but we know the transfer of value is generally done through the publicly available blockchains, which is either the Bitcoins or the Ethereums or the stable coins and all, right? So many of them are restricted for use, and many of them are regulated by the regulatories, right? So blockchain in itself uses the cryptography and the Merkle-Tree algorithm, and it is tamper resistance. So Merkle-Tree algorithm is something like your previous actor. I mean, your act is depending upon your previous actor. So in case you want to tamper your act, your previous actor's act also has to be tampered with, right? So that is why it becomes a tamper-proof system. But please note down these letters in bold, okay? And I will tell you those things which can also work as for legitimate as well as illegitimate purpose, right? So you know that the blockchain has peer-to-peer transfers. There are no intermediaries, no reliance on banks and central authorities, right? Um, if I have to transfer the dollars from, let's say a part of the world in, let's say, New York, to another part of the world let's say India or Bangladesh, we will be paying a dollar value of about $5 to $8 per $100 transfers, right? So when it comes to blockchain, people have figured out that it is very, very less, right? It is at 0.5 cents also, right? Depends upon the timing, of course. So there are multiple natures of doing this. There are a proof of work, proof of value, gas, okay, and the more you spend, you will be able to transfer it faster. But ultimately, it gets transferred. When it gets transferred, the value is available. Value gets deducted from the buyer, from the seller, and it is transferred towards the buyer, right? So now the cryptocurrency in itself cannot be of value unless it has been traded further, right? So that is where you require the copy of transactions available for each participating entity, and those participating entities will be the one who will be doing a transfer next. There are multiple examples of this. The very, very recent ones are the stable coins, utility tokens, and the CBDC, right? And if you have any questions, please feel free to ask. We will make it interactive. Now, when we look at the participants and the stakeholders for a virtual asset, who are they? Okay, and it is very important from a regulatory perspective to understand who are they. And if you look at the paper in 2021 by FATF, you'll be able to figure out that they are broadly categorizing into 4 aspects. One is the user. Second one is the service provider, and they're putting lot of weightage on the service providers. Then the exchanges, and then the banks, right? And if I just go back a slide, that the letters which I was showing in bold, let's look at those letters in a legitimate usage and illegitimate usage as well, to understand what is good for us and what is bad for us, right? And as risk professionals, we will be able to see if the red box can be dealt in a better way, right? So what are the good ways of doing it? Of course, you are doing the investments, you are doing the trading, and of course, if you have the registered exchanges, your trading is up to the mark, and it is being seen towards the participating entities as well as the regulatories, right? So you do a buy and sell stuffs up to, let's say, an allowed limit, let's say $2,000 or $20,000. You can set the limits based upon the jurisdictions, right? And then use the FIU registered VASP providers. Now, what are the illegitimate usage of this is the moment you transfer the value, you don't know where exactly it is getting transferred further, right? And this is where the funding of terror and the narco activities happen. There are multiple tradings happen on dark web. So you might be seeing there are multiple cryptocurrencies which will keep coming as mushrooms at some part of the world, and then suddenly vanishes with the money, right? That is a big problem, and that is an illegitimate use of the cryptocurrencies, the virtual assets. Now, there are instances where you transfer funds beyond limit, okay, beyond FIU limits. Now, extortion is another thing, and if you look at the cybersecurity or the attacks which is happening from the cybersecurity, they will be doing the extortion through that channel only, right? Now, what can we do? Okay, we have to understand the entities a little bit into deep. Okay, let's look at FATF guidelines and their recommendation towards this. Okay, so what they are doing is in the left-hand side of the picture, if you see, they are telling us to do an initial risk assessment. I think all of us knows what the risk assessment happens, how the risk assessment happens. But here the initial risk assessment should be happening for all these in the right-hand side of the picture. You can see the originator, beneficiary, VASP, and the financial institution. Now, we have to do the risk assessment, and then the exchange and transfer should happen. Now, exchange and the transfer should be monitored. Okay, this should be like I will exchange Naira with eNaira, okay, which is the CBDC of it, how much is getting exchanged every day? Okay, how many people are there? How many customers are there who are exchanging it? Who are the VASP who are exchanging it further, and who are the beneficiary? So all this information is what you require, right? This is difficult in nature. Okay, it is not possible for a financial institution to get into this and look at it every time, right? Now, let's look at it a point of view that the customer is not only originating or benefiting from the transfer of virtual assets, they're also playing around with multiple other instruments of your bank, right? For example, they do a cash withdrawal, cash deposits, and then they use that fiat currency towards doing the CBDC. And then from the CBDC, they do them tokenization. And then from tokenization, they do NFT. And then they do the cryptocurrency virtual assets transfers. So how complex this becomes. And that is where the multiple coordination between these participants and um, the financial institutions from the nation is very, very important, right? FATF, along with multiple regulatories, are already coordinating along with multiple blockchain analytics platforms. They are coordinating, they are figuring out where the money is going, and it is happening at a regular basis. As we speak, the coordinations are also happening when the transactions happen. It can happen at a delay, but that is finally happening. There are some limitations about that coordination, which may not happen based upon your restrictions or jurisdictions or country to country transfers. There are multiple countries who open that particular bitcoins or Ethereums for your normal purchases also, right? So in that sense, they might not be tracking every details of a particular customer. Now, this coordination is very important. FATF is recommending that this coordination should happen, and the crimes are rising there. If we coordinate very well, we can work as a single force against the financial crime, right? Of course, record keeping is something which we generally do. Okay, for every other aspects, where you require the record keeping for at least 6 months to 1 year. In case your financial institution wants to do the reporting to the FATF, right? So let's proceed further and see how the global approaches are shaping up for the digital assets. Okay. Now, we look at the progressive approach. There are multiple countries who have a very progressive approach towards this. Like as I was saying, that they do the transactions, the day-to-day transactions based upon this, right? So this proactive approach helps them a lot. Okay, like for example, if you look at UAE, okay, this has become a hub for blockchain-based transactions. Every blockchain-based applications can be hooked there, and transactions will start working. There have been regulations, there have been analytics behind this. Of course, there are technology revolutions also has happened towards this, and that is where they are right now. Now, the second portion which comes as regulated acceptance, there are very, like for example, US. Okay, so stablecoin is regulated right now, and it has become a part of acceptance for everyday's life. People are able to trade with that. Other currencies has not been encouraged so far. So there has to be a regulated approach and government backup, right? So that is where the regulated acceptance will come in. Third part comes as a restrictive approach, and this happens in India, China, and Nigeria. So the trading happens, but we also have the consumer protections concerns, and the laws are devised in a way that it protects the customer, and it stops the capital to be going out from the country, right? And they should also know that the source of the funds are not being used for illegitimate purpose, right? So that is the restrictive approach. And there are countries where it is prohibited. So people have started, but there have been extremely illegitimate usage, and then things has to be stopped, Now, if you look at all these four approaches, the central point of all these four approaches for the regulator from the regulatory side, and of course, I'm actually playing the advocate from the regulatory side, is towards the customer protection, right? So, and many youngsters are coming into this part, right? They invest onto the cryptocurrencies, and then somebody the cryptocurrency method or the institution suddenly vanishes. They lose money. So quick money everybody wants, but suddenly the money also can go, right? That's a capital flight. That's a big challenge for almost all the countries. Tax evasion. So tax evasion is something which is very um, important, urgent, and if you know that things do not work if the government is not able to earn enough from the taxes, right? And the best part, or I think the worst part of technology is that we don't have frameworks which is working for every bank. Okay, it only works for tier A bank who can spend a lot of money to get the framework ready, but it does not work to the last person in the chain, right? So that needs to be protected. So if I look at today's topic on how Basel III applies here. Okay, so I mean, of course, the Basel Accords and all the things from 1 to 3. I'm just talking about Basel III right now. Okay, so if I look at the left-hand portion where the credit risk, market risk, liquidity risk, operational risk, counterparty risk, and concentration risk. So counterparty risk is also very important here, okay? Because the VASP, which is the person who is actually servicing the cryptocurrency exchange between the buyer and the seller, is the one who will be coming into the counterparty risks, right? So let's look at the right-hand side of the topics like lending against Bitcoin as collaterals. Okay, there are some banks who do that, right? So what do you think that it will come as a credit risk, market risk, liquidity risk? What should be the right fitment for it? Okay, so I mean, it can be anything based upon the financial institution's way of looking at it, right? So when you look at the collateral not being paid, it becomes definitely a liquidity risk, right? And if the money is going to get into the Bitcoins, it definitely becomes a credit risk, right? So holding a cryptocurrency on the bank's balance sheet, what kind of risk it is? Market risk, liquidity risk, or operational risk? So similarly, cyber attacks on a crypto wallet. So this is one of those particular places where your counterparty risks are challenged, right? The counterparty risks come into play, right? Then difficulty liquidating the crypto during the market stress. That is another problem which almost all the risk professionals face. Then the exposure to a crypto exchange or custodians. Then the excessive exposure to one cryptocurrency, right? So one of those cryptocurrency network vanishes and you lose everything, right? So now let's go and see what exactly it is, right? So risk identified by Basel, okay, which is lending against Bitcoins as collateral, okay, which falls under credit risk. Similarly, holding cryptocurrencies on the bank's balance sheet falls under a market risk, right? Cyber attacks on cryptocurrencies becomes operational risk as well as counterparty risk, okay? And difficulty liquidating the cryptocurrency in the market is a liquidity risk, right? So similarly, you can map each and every risk which is associated with the cryptocurrencies or the virtual assets. Now we'll go a little bit further, okay, of how deeply we analyze things or how deeply FATF analyzes things, and then we catch up towards that. Okay, and of course, the moment I say FATF is analyzing this, it is not only FATF because the coordination has to be done at every nation's perspective. So those nations also participate a lot into it, right? So when we talk about the service provider, which is in the left hand side of the picture, okay, what we need to do as a financial institution is we need to register and provide them the bank account number. So virtual account number concepts can be used. Okay. And if they are holding the credit card information, they have to share that information, that the credit card information has been held here. And the transaction limit is what the financial institution can set, at how much fiat should go into crypto, or how much crypto should come into fiat as a daily limit or a weekly limit, right? Similarly, the second part is when the service provider asks for authorization from the bank, okay, and while sending the transaction limit. Like for example, let's say I want to transfer Bitcoins, right? I want to transfer Bitcoins of a value of about, let's say, 10 Bitcoins in a week, right? That's the max limit. Similarly, bank informs about a registration attempt and asks the customer to authorize this, right? So as a financial institution, we cannot go and directly interfere with the customer. The VASP can talk to the customer, and then they can ask to authorize this kind of transactions, okay, or register themselves. So then the next part will be the bank will be providing the transaction limits. So bank can always do an override here. Okay, they can say that the VASP is asking for a 20,000 limit, but bank can only give a limit of about 10,000. Okay, bank has always that particular freedom to do that. And the regulatory also doesn't stop bank from putting a limit, right? Of course, bank should not overboard the limit. Bank can always put a limit towards this. This can be done. Okay. At the end of the day, or at the end of the transaction period, it can be maybe a day's limit, or it can be hourly limit. They will send you a flat file, okay, saying how much has been bought, how much has been transferred and all, right? Based upon all these 5 pointers, okay, a suspicious activity report is generated, okay, and that goes to the financial institution, financial intelligence unit, or the central bank, right? And that is broadcasted towards the network of the banks. So this is the complete flow of how the FATF and the regulatory is wanting the financial institution to report towards this. Okay. If there is any questions, I can help answer this, or we can take those questions later as well. Okay, now what we have designed and what we are working towards is we look at the customer. So we look at the customer here, and we look at the service providers here. We look at the banks also. Okay, and we take these kind of information towards our platform. Okay, so we take the registration details, KYC info, customer name, wallet info, beneficial account ownership, transaction info, rules, thresholds, and similarly, FI, the financial institution, we take the fiat currency exchange information, right? This is very important. Now we use all these things and generate analytics out of this. So we look at first we do the screening, then we do the pattern analysis, okay, how the spend is happening. Then we do the customer risk categorization, and we take the enhanced due diligence information. If required, there are alerts, and if there is a continuous monitoring required, that will be also done. That also is done. And then the fiat and the cryptocurrency behavior analysis. Okay, and then system automatically generates the STR, SAR reports, the pictorial representation, and then towards the regulatory. Okay, so this is one snapshot, okay, which is available. Okay, and in case you want to see the system, I can show the system also, but I will take a pause here and I will listen to you. And if any questions, please feel free to ask. Okay, I will stop sharing. Okay, in case you want me to show the system, I can show the system as well. Any questions here? Okay, so over to my moderator. Would you like to suggest what should we do here?
Okay, thank you very much, Tammy. God bless you.
Yeah.
Thank you so much. So it's time now for questions. Right. Do we have any challenge? Do we have any issue to discuss with Tammy? We brought him here for a purpose, you understand? And, you know, this is the opportunity, you know, that you have to interrogate, to ask questions. You understand? We are talking of Basel Accord, Global Financial Regulation, right? What are the challenges? What does Basel have to do? What do we have to do as at now? Because of the fact that the traditional, things that the Basel was set up for, right? You know, of course, the game is changing. The risks are changing. We are having new risks now. That's why we are starting with the digital aspect. So please make use of this opportunity and ask questions. From Tammy, right? Thank you. All right.
Yeah, can I ask this question? Can you hear me?
Please,
yes, I can hear you. Yes.
What are the new risks that we are experiencing in the recent 1 year or 2 years compared to what we were experiencing before, especially in the cryptocurrency space?
Okay, sure. I will answer this question. So what we have seen is in the cryptocurrency space, you would have heard about recently. There is a company called as Binance. Okay, where there is a theft of about $3.1 million amount of cryptocurrencies. Now, what they have done is the criminals have done is they have targeted the VASP directly. And because the VASP holds a particular vault with them, which is used to exchange the cryptocurrencies between the participants and the beneficiary and the customers. This is the vault they have targeted, and they have siphoned the money from the vault and they have taken it to their vault itself. There are pits and falls towards doing this because you cannot use the cryptocurrencies in itself. The criminals has to exchange it to fiat. Now, if I look at the layering and the placement and the structuring behind this, what they do is the criminals do is they try to divide the money into multiple small accounts. Okay, and then using layering techniques, they would do the fiat currency exchanges. In a different forms. They might as well go and buy an NFT and then they sell that NFT and give it in cash. So this is one of those tremendous frauds which we have seen, which is happening recently. That is number one. Number two is extortion. Okay, so you might have seen that they will be injecting malwares into a system, and then they will lock every user, and then they will pop up a message on the screen saying that if you pay X amount in cryptocurrencies, then only we will be letting you go, letting your system go, right? So this is one of the extortions which we have seen through cryptocurrency usage. And if I look at people behind it, okay, it's not so scary. I mean, there are criminals and there are people, there are angels also who are actually helping us to figure out what exactly happening and who is taking the money from which wallet to which wallet, from the bitcoins from which vault has gone to which kind of wallet IDs. There are people who are analyzing, they're figuring it out. They are getting the amounts available, how much has been exchanged, everything. The analytics part of it is very challenging technically, but they are doing it, right? So this is the second example which we have seen. The other example which we are seeing in India, very prevalent, is the usage of mule accounts. So people are using multiple, you can say, pseudo accounts to do this kind of transactions in small portions. Of course, not only crypto, but it is prevalent across multiple types of instruments of financial institutions. So yeah, there are three things which we can see definitely are prevalent crimes right now.
Okay, thank you.
Sure, thank you. You're welcome. And thanks for the question. I think that was a good question. Any other questions, please?
Sorry, good afternoon. My name is Kayo Diosuma.
Hello. Hello.
You spoke around valuation of virtual assets. Please, can you elaborate a little bit on how the valuation of virtual assets? So maybe you just use an example to share your ideas around valuation of virtual assets. Thank you.
Sure, sure. So virtual assets are valued based upon the investment in nature, right? So we did not know stable coins just 5-6 years ago, right? So we know the value now because somebody has invested onto it. So all the virtual assets are the ones when they're transferred, and if the nature of P2P transfers are in a way that people are getting the benefits and they're able to cut short the intermediaries in between, okay, then they start gaining trust onto that particular currency. So that is a step number one. So you start setting up a trust onto the currency. Okay. So once you have that trust network been built, once the customer, the multiple buyers and sellers start doing the transactions, you use multiple ways of increasing the valuation. It can be proof of value. It can be based upon gas. Okay. And it can be based upon your performance of the network. You can always say that the price has changed right now. Okay, and more people are towards the buying and selling of that particular assets. The valuation will keep on increasing. So you know that Bitcoin's valuations have increased 400 times in the last 6-7 years. So that's how the valuation works in the virtual assets.
Thank you very much. That's clear enough.
Sure, thank you. Okay, any other questions? Okay, so if there are no other questions, I will hand over the baton towards the moderator. And thank you so much for having me here. It is lovely connecting with all of you. I would wish to stay connected with most of you, and in whichever form I can help, I will surely help you as much as possible. Yeah, thank you so much.
Can we please clap for our moderator or our guest speaker? He has done very well for us. This is a wonderful one. Thank you so much. Thank you so much. Thank you so much. We've gained a lot.
Most welcome. Thank you. Thank you so much for having me here. Yeah.
Thank you. So while we wait for another important guest speaker, you know, as a professional, this is a journey. It's not just a one time, it's a journey. This is a journey that started about 4 decades ago, from Basel I to Basel II, from Basel II to Basel III, and now we are in the Basel III and finalization. So we have a lot of things to benefit from all these panelists. So I still want to encourage every one of us that we need to ask them questions. Let's get the best out of them. More people are coming very soon. So as they come, please, let's create that opportunity to learn and to grow our horizon. It's an opportunity for us while we wait for our next speaker. Thank you. Please hold on for a while we wait for our next speaker.
Hi, everyone. Hello, am I audible?
Yes, I can hear you clearly.
Thank you. So, this is Shadi Abujade this side from Aptiva. I'm representing Aptiva today. So I'll give a brief background for myself, and then I'll give my short presentation on Basel and emerging risks related to it. So I've been working in the enterprise risk management space, particularly supporting financial institutions on risk transformation, Basel implementation, and technology-enabled risk management. Maybe some of you may already know Aptiva, as we've been engaging with several banks across the Nigerian market recently on strengthening enterprise risk capabilities, including technology risk management. What I'm planning to discuss today, I'd like to share some observations from my work in the region and on what we've been doing across different institutions, mainly or particularly around how technology risk is evolving and what we've seen banks doing in that response. So one of the areas that we've seen and talking about the risk landscape, which has fundamentally changed recently, one of which is over the last few years, the banking industries, I would say it has experienced an unprecedented level of uncertainty, right? And recently, not far off in the GCC region, geopolitical conflicts, supply chain disruption, sanctions, cyber warfare, AI adoption, cloud dependency, increasing regulatory expectations have created a more complex risk environment than what many institutions planned for even 5 years ago. And I'll give that example on the GCC region, specifically on the recent war, in a couple of minutes, if you may allow. Generally, these risks are no longer isolated events, meaning a geopolitical conflict can quickly become a cyber risk. It can quickly become an operational risk, and it can move into becoming a third-party risk and ultimately a financial risk. Now, on the third-party risk, coming from a geopolitical risk, that is, as we've seen recently, that given the war that has happened and what we've seen during this war, recent war in the GCC region, banks have treated geographic separation as sufficient for disaster recovery. Okay, and if we're looking at disaster recovery, today geopolitical development are changing that assumption. Regional conflicts remind us, and what we've seen now is that disaster recovery planning can no longer focus solely on a, let's say, natural disaster or a technical failure, right? It must also account for that geopolitical and regional security risk. In the recent war, when the DR environment has been hit, local banks assume that in one jurisdiction, two different production and DR sites, completely distant from each other, are not under a risk. However, this geopolitical risk has shown that geopolitical risk zone is important and it should be taken care of. A single regional event could impact both those sites. So this is becoming an important consideration for banks reviewing their operational resilience strategies. Many financial institutions, and I'm taking the example of GCC because of the recent war, including those using DR sites in the UAE, are reassessing this concentration risk, and they're considering this as a concentration risk, right? This question around this, and the question on whether DR is far away or not, is the right question? No. So the question is it sufficiently independent from the same geopolitical infrastructure and supply chain risk? That is the right question. So this aligns in a way broadly towards the operation resilience shift. Regulators increasingly expect banks to identify and manage this concentration risk, not only across cloud providers and data centers, but also across geographics and geopolitical domains. So recovery strategies should be tested against scenarios that were considered unlikely just a few years ago. I just wanted to raise this point, given that this is what we've seen recently, and we've seen central banks reacting in that manner and pushing to make sure that DR and production sites are completely geopolitically, so to say, risk-free in a way. So this takes us back to like the technology, which is a major source of enterprise risk, right? Where traditional banks focused heavily on credit, market, and liquidity risk.
Okay, we have our next speaker now. Dr. Fatih. Hello.
Sorry, come again?
Hello.
Yes,
Are we
sir.
trying to get
Dr.
Dr.
Fatih again.
Fasipe of CBN?
Yeah, thank you.
Hello.
I can
Doctor,
see
how
you
are you?
now.
I'm
Thank
fine,
you so
sir.
much.
Well done, Dr. Fasipe, for joining us. We appreciate.
Thank you so much, sir. Thank you so much. Okay. So thank you so much.
Now you have the floor.
Okay, thank you so much. Thank you. The chairman of this occasion, the president chairman of the Association of Enterprise Risk Management Professionals, our esteemed keynote speakers, distinguished members of the association, distinguished invited guests, ladies and gentlemen, good afternoon. It is a privilege. It is my privilege, really, to bring before you this presentation, which is titled "My Privilege to Address This Gathering on the Basel Accord Day of the Association." Before I begin, permit me to note that the views I shall express here this afternoon are entirely mine. They are entirely my own view and should not be taken as the official position of the Central Bank of Nigeria. So with that, let us turn to the tax before us. Now, the title of my presentation, which was given to me by the association, and that is the tax before me, is to do justice to this question. Basel III finalization, the journey from a regulatory perspective. Can capital regulation keep pace with emerging risks? That is the tax before us, and I've been asked to decipher and provide an analytical response to that question. Can capital regulation keep pace with emerging risks? And I would attempt to provide some answer to this Thank you so much. I would like to share my presentation. Let me just see. Let me pick that. Organizer, can I share my presentation, please? Hello?
Please go ahead. Thank you.
Yeah, okay. Oh, sorry, I'm having this technical.
Hello, sir.
Yeah, please, Dr. Fashikwe is still trying to share some technical challenges. We will overcome just shortly. Thanks so much.
Hello? Hello?
Welcome, sir. Welcome, sir. Thank you for coming.
Okay.
I
I'm
think
really sorry
Mr.
about
Fasipe
that.
is trying to.
I
Mr. Fasipe,
have some
I think
technical.
we should just go
I'm sorry.
ahead with the copy you are having
Okay.
without
Okay.
sharing.
Good.
I think you should go ahead, please.
Okay. So I have before me the task of doing justice to the assignment given to me by the association, which is a Basel III finalization, the journey from a regulatory perspective. I'm a regulator, so this is the question, and I believe this is the central theme of this conference. The question is, can capital regulation keep pace with emerging risks? Now, at the starting point, there are three things I would like to. Okay, next slide, please. There are three things I would like to bring to the fore to just put emphasis on. The first one, three terms. The first one is capital regulation. And the second one is Basel III finalization. And then the third one is emerging risks. I would want all of us to be on the same page with respect to these terms, these concepts. So what is capital regulation? At its simplest form, capital is we know capital is the bank's own money, the shareholder funds retain profits that stands behind the risks it takes, absorbing losses so that depositors are not the first to suffer. So capital regulation is the body of rules that fixes how much of these loss-absorbing own funds a bank must hold relative to risks, how risky its assets are. So in other words, capital regulation is a body of rules that prescribes the volume and level of capital, the type of capital a bank is required to hold. So that's about the first term. And then the second term, Basel III finalization. This is the package the Basel Committee on Banking Supervision, BCBS, agreed in December 2017 to complete the post-crisis reforms. Because its effects on the measurement of risk-weighted assets is large, the industry often calls it Basel IV, though the committee insists this only finalizes Basel III, so it's not been officially taken as Basel IV. So in some aspects, we call it Basel 3.1. So that's about the term Basel III finalization. And then the third one is emerging risks. These are newer threats. The older framework was not designed around. And these threats are climate, extreme weather, cyber and operational fragility, the opacity of artificial intelligence models, the volatility of crypto assets, deposits runs accelerated by mobile banking, the migration of credit intermediation out of banks into non-bank sector. Now, I'm going to be giving you a perspective from the regulatory stand. And because of that, at the end of this, my presentation, I'll be making a verdict just to let you know my final position. And I believe where, as an institution, the Central Bank of Nigeria is headed with respect to emerging risks. Now, at this point, it is worth noting that capital regulation is not well suited to responding to novel risks, what we call emerging risks. Capital requirements are calibrated on historical loss experience, the risk weights, the model parameters, standardized buckets are all distilled from losses that have already happened. So a risk with no history, a first of its kind, such as cyber attack, climate transition shock, the whole run through or a bank run through messaging app offers nothing for the calibration to bite on. So for the first part, I want you to understand that what we call capital regulation is really driven by historical experience, historical data, and therefore it is backward leaning. So next slide, please. Now, there are two cases that bring this concept better to fore, and one of the two cases is the fall of Silicon Valley Bank in March 2023. Silicon Valley Bank, a mid-sized United States bank with around $200 billion of assets, collapsed roughly in 48 hours. Within 48 hours, on a Friday, the bank was in existence. By Monday, the bank was gone. What happened? Now, look at another one. Credit Suisse, a global systemic institution with a history of more than a century and a half, had to be absorbed by a competitor. It is a state-brokered weekend rescue. Now, the captivating feature of this event for us is that the capital ratios of these two institutions look adequate almost until the moment they failed. If capital adequacy were the same thing as safety, neither bank should have failed the way they did. Neither of them should have failed the way it did. So the Silicon Valley Bank story, is of peculiar interest because its mechanism is the mechanism of the whole argument before us. The bank had taken in a very large volume of deposits from a concentrated clientele of technology firms, many of whose balances far exceeded the insured limit, and it invested much of this money in long-dated government and agency bonds. Long-dated bonds are highly sensitive to interest rates. When rates rise, their market value falls. And the longer the maturity, the sharper the fall. This is duration rates. As rates rose throughout 2020 in the US, the market value of the bank bond portfolio dropped substantially. Now, the authorities in the US, the supervisory authorities in the US, had what we call an accumulated other comprehensive income feature, which allowed this bank to keep these losses out of capital. However, these depositors of this bank were sophisticated. So when these sophisticated uninsured depositors understood this gap, that there had been mounting losses in the OCI feature of the bank, which had been separated from the capital of the bank. So they move not in a slow queue at a branch, but through their phones in hours. So roughly $42 billion left in a single day with a comparable sum queue for the next morning. So in 48 hours, the bank was gone. So now, three things. The major lesson for us with this is that it forces apart three ideas that we often put together. Solvency, number one. So solvency asks whether a bank can absorb losses over time. It is a capital question. Two, liquidity asks whether a bank can meet a sudden demand for cash when funding freezes. It is a question that the composition and stability of funding, not about capital. Then confidence is the trigger that converts a latent weakness into acute crisis. And in the modern environment, it can collapse at the speed of a viral message. So a bank can be solvent on the regulatory measure and still die of a liquidity run driven by a collapse in confidence. So Silicon Valley did exactly that. Next slide, please. Next slide. Thank you. So now the question for me, the central question we have before us, can capital regulation keep pace with emerging risks? I think I'm of the opinion that we may have to reframe that question, and I'm going to put before you the reason. So before we go on with that, I also want to make a certain distinction. First, according 3 moves. So we'll make this analytical distinction between capital regulation, prudential regulation. Then we look at keep pace. Is it the right standard? I believe it is not the right standard. So the first distinction is between capital regulation and prudential regulation. The capital regulation is a narrower concept. Prudential regulation is broader. It is grounded in the 3-pillar architecture. Pillar 1 is the capital formula proper, computing minimum capital against credit, market, and operational risk. Pillar 2 is the supervisory review process in which a bank conducts its own internal capital adequacy assessment, and the supervisors evaluate and challenges it with power to require capital and action beyond the minimum. Pillar 3 is a market discipline through public disclosure, which works only to the extent the market receives information it can act upon. So when commentators or when participants at this conference ask whether capital regulation can keep pace, they almost always mean Pillar 1 capital. But I will make this move. The first move is to widen the lens, is to a whole of prudential regulation, not just so we won't limit that question to Pillar 1 regulation. So we're going to be including into that question capital regulation. We're going to be including in that Pillar 1, Pillar 2, and Pillar 3 as well. So that's the first move I'll be making. And then the second move I want to make is to ask whether capital regulation can keep pace, is to set it as a test, which essentially it is incapable of passing. Because capital rules are backward-looking and slow. They are calibrated on historical loss data and change only through cycles of construction, legislation, phase implementation that run for years. So essentially, capital regulation will not keep pace with the movement in emerging risks. So the third move I will be making is to make a distinction between Basel II finalization. Is both an end game and a starting point. It is an endpoint. It's an endpoint in that Basel III closes the long post-crisis reform agenda that was started in 2009. It introduced better capital, liquidity standards, leverage backstops, resolution tools, and the recalibration of the models are now substantially in place. It is also a starting point in the sense that it must now confront a new set of risks, which were never contemplated in 2008 when we had the first Basel III, after the called the post-crisis Basel III. So the same framework wears two faces, and there's constantly a tension between what it was set to achieve and what is confronting the framework, the Basel III framework today, which is the emerging risks. Next, please. So the whole journey of Basel I to Basel III, it may be tempting to look at the whole journey as a movement of one framework from one date to the other. But what actually is happening is that we can liken this but that's the movement from Basel I to Basel III. We can liken it to a pendulum swinging between two values that are both legitimate and in permanent conflict. So now, the two values are risk sensitivity, which means tailoring capital requirement to how risky an asset actually is. And his appeal is that capital tracks real risk. And then the second value, the second legitimate value, simplicity, means standard uniform rules that every bank applies the same way, which we call the standardized approach, so that resulting numbers are comparable and resistant to gaming. So each of these values is shadowed by a vice. So risk sensitivity on one hand, pushed too far, becomes opaque, procyclical, and gameable. And on the other hand, simplicity or the standardized approach, when you push that too far, it becomes crude and may invite arbitrage. So, for example, the Basel I of 1988 started with when it came out with the credit risk aspect, introduced certain level of risk sensitivity when it divided credit risk bucket into four different classes. We have the 0% classes, we have the 20%, the 50%, the 100% classes of credit risk. Now, the idea behind this is to ensure that the risk sensitivities in lending are captured. For example, claims on highly rated government instruments are treated as 0% risk, that is, they are risk-free, so they use up no capital at all. Then the 20% bucket represent claims on banks and certain public sector bodies. 50% residential mortgages, and then we have the highest in terms of risk sensitivity, which is the lending to ordinary corporates and also personal lending. So Basel I actually introduced risk sensitivity by this classifications of credit risk into four different risk buckets. Now, Basel II came with an improvement in the quality and quantity of capital, now emphasizing equity tier 1, which is the highest quality, almost genuinely loss absorbing capital above the weaker instrument that had failed in 2008. It had a capital conservation, counter-cyclical buffer, charges for global systemically important banks, a non-risk-based leverage ratio backstops, And for the first time in global framework, liquidity standards, liquidity coverage ratio, net stable. Okay, so that was Basel III. So Basel II, we came in 2004, built 3 pillars, and allow sophisticated banks to model their own risks through internal rating-based approach, estimating probability of default, loss given default, exposure at default, and maturity. So in practice, banks were allowed to model the risk sensitivities in their portfolio. And it also allowed banks, because it's also made provisions for standardized approach, where you have the same methods applied by all banks. Basel III, which was the first set of Basel III, which is a post-crisis Basel III of 2010 to 2017, improved the quality and quantity of capital, emphasizing common equity tier 1 above the weaker instrument that had failed in 2008, which was Basel II. It added capital conservation, counter-cyclical buffers, surcharge for global systemically important banks, and a non-risk-based leverage ratio backstop for the first time in global framework. We also have liquidity standards, liquidity coverage ratio, net stable funding ratio, and resolution loss absorbency. So this enlargement beyond capital is half of the event of the eventual verdict, which I shall be making. So established years before the margin risks debate. So then the finalization of December 2017, which is called the endgame, retightening the models. It revised standardized approaches, provided input floors on internal ratings, the standardized approach to counterparty credit risk, a revised credit valuation adjustment charge, the fundamental review of trading book for market risk, a single standardized measurement approach for operational risk and the output flow. Now, the takeaway for us at this point is that a standardized rule or a standardized approach should be watched for arbitrage and crudeness. On the other hand, a heavily model rule in terms of internal rating-based approach should be watched for opacity, procyclicality, and gaming. So the whole history of Basel and much of its future is the management of this single trade-off between the standardized rule on one hand, and then the risk-sensitive approach, which the internal rating-based approach on the other hand. Next slide. Now, the output flow. To understand the output flow, one must understand the denominator of the capital ratio. The denominator of the capital ratio is the risk-weighted asset, and the risk-weighted asset are the bank's assets, and they are scaled by a weight that reflects the assessed riskiness, so that a portfolio of safe assets produces a small requirement, and a risky portfolio will end up in a bigger capital requirement. Now, the whole risk-sensitive project depends on this weight being accurate and trustworthy. So, and that is the idea. So the problem Basel II created was that banks using internal models could drive their risk weight, and so their risk-weighted asset far below what a standardized approach will produce. Sometimes for good reason, sometimes because of optimistic modeling. Because every bank modeled differently, numbers were not comparable. So you have two banks having similar portfolio, coming up with two different capital ratios, because they have done their modeling in a different way. Of course, they won't be the same. And because lower model weights mean lower capital, the incentive to come into the internal rating-based space it was there. So trust in risk-weighted assets, the foundation of the framework was eroded. Now, what the output floor is designed to achieve, a bank's total risk-weighted asset computed using internal models may not fall below 72.5% of what the same exposure will attract under the standardized approaches. So the standardized calculation is run in parallel as a benchmark, and the model results may drop below 72.5%. So this particular figure is a product of a long negotiation, principally between model-reliant European banks, which press for a low floor, and standardized approach American banks, which were comfortable with a higher one. So, and the reason the floor deserves to be called the synthesis of the whole journey from Basel I to Basel III is that it resolves the pendulum's tension. That's the conflict between the risk sensitivity through internal rating base, and then on the other hand, the standardized approach, which affords greater comparability among banks. So, why do we have this? Why do we have the 72.5? So we can say it preserves. It was designed to preserve risk sensitivity, because internal models still drive primary calculation and still differentiate safer from riskier exposure. But then it bounds at the same time that sensitivity with a standardized backstop, so that model numbers regain a common meaning and a flow of credibility. So it is an attempt to hold the pendulum in the middle, to keep precision of models and the comparability of standardized approaches at the same time. Thank you. Next. So now let's look at this from the experiences across jurisdictions. We have now in the talking about the implementation of finalization Basel III in the European Union. The European Union has implemented the finalized rules through its capital requirements regulation CRR and directives, applying them from 2025, with the market risk framework deferred to 2027, and the output floor phased toward 2030, alongside transitional measures to soften capital impact on European banks. The United Kingdom, on the other hand, now setting its own course through the Prudential Regulation Authority, has scheduled its own version of implementation for the beginning of 2027, having deferred the date more than once, with the internal model approach to market risk pushed back to 2028. So, meanwhile, the United States presents the most instructive case in this instance. Its first attempt was proposed in 2023, and this would have raised capital of its largest banks by something in the region of 16 to 19%. That proposal for the takeoff of the finalization Basel III met fierce industry and congressional resistance and was withdrawn. And a proposal was made recently in March 2026, and this has taken a very different shape. And they now talk in terms of broadly in terms of capital neutral and more reliant on standardized approaches. So we have different brands of implementations across this jurisdiction. We were talking about the same text, the same capital rules, and then we have different implementation timelines. We have different experiences of implementation across these key members of the Basel committee. Now, so it is tempting to treat divergent implementation timelines and features as mere administrative issue. No, they are more than that. When rules differ across borders, activity and risks migrate towards wherever rules are lighter. So in a process of regulatory arbitrage that can follow out the intent of the standard. So there's a particular irony. The output floor exists to restore comparability. Yet, if jurisdictions calibrate differently, the capital ratios of a globally active bank come to mean different things in different places. So what I'm trying to bring out here is that Basel has moved from Basel I to Basel III, and with the implementation, with the development of one capital accord, the plan has been to correct the last one. But then there has been certain central issues across these implementations, these implementations of Basel I to Basel III. And those issues are whether to keep with the risk-sensitive measures, which are carried out through internal models, or to have the standardized approaches in place. And because Basel found out that with Basel II implementation, there was a wide divergence between numbers generated from internal models and standardized approach. They introduced the output floor. The output floor was to limit this divergence, but then we have this other risk coming up now, which is in terms of different implementation practices across Basel committee members, which for me is another emerging risk. Now, in the case of Nigeria, we have traveled the same broad path as most banking systems, from the simple common standard of Basel I through a guided and phased adoption of Basel II and Basel III towards the finalized elements. And the capital adequacy requirements for us are a minimum of 10% for banks with national or regional authorization and 15% for those with international authorization. And following the recapitalization, which we will examine in the next slide. Next, please. The more revealing picture emerging across these three pillars, which do not mature. Next, please. Okay, so now our experience, and this is not peculiar to us as a system, is that the implementation of Basel I to Basel III, the architecture of the framework, talking in terms of Pillar 1, Pillar 2, and Pillar 3, what we have experienced is that the Pillar 1, Pillar 2, Pillar 3 have matured at different pace and at different level. Now, Pillar 1, the capital formula, is the most embedded in our system, in our regulation, because it produces a number which a supervisor like me can compute and and relate with, and which I can verify with you. Now, Pillar 2, which is the supervisory review process, built on banks' internal capital adequacy assessment and supervisor challenge of it, is where the greatest supervisory value lies. However, this has not taken that central role or that significant role as Pillar 1. Pillar 3, market discipline through disclosure, is typically the weakest in practice. And across emerging markets in the world, this is what has been observed. So Pillar 1, Pillar 2, and Pillar 3 have not matured at the same pace and at the same level. So, and what we have done is that we have put this in what we call a maturity gradient. Now we have strong Pillar 1, we have a developing Pillar 2, and we have a weak Pillar 3. So this is not peculiar to Nigeria, but it is a structural feature of supervisory system everywhere in the world, especially with emerging markets, and it bears directly on this conference question. So if the answer to emerging risks lies in supervisory judgment, scenario analysis and market discipline, rather than higher capital ratio, then it lies disproportionately in the two pillars that are least developed. So, but is that the case? So, building credible Pillar 1 and Pillar 2 capability is harder and slower than raising a capital ratio, because Pillar 2 and Pillar 3 requires people, skilled people with the right skill set, data, systems, and a supervisory culture that cannot be conjured by a circular. So that difficulty or that challenge is precisely why it is the binding constraints on resilience. So Basel is a minimum standard accompanied by many of national discretions. For us, we have exercised certain discretions with our implementation and the principle of proportionality. So the application of lighter, simpler rules to a smaller and less complex institution. So the Nigerian discretions that matter most include the treatment of local currencies, sovereign exposure, support factor for small enterprise, infrastructure lending, and the handling of foreign exchange and concentration risk. So proportionality operates through a tiering of institutions which we have in place, and everyone familiar with the structure of the organization would see how departments are laid out. So that's a good reflection of the principle of proportionality. So now the takeaway for me for this slide is that the Nigerian future confirms a general truth. So the easier pillar to perfect is the one that matters least for emerging risks, and that is Pillar 1. The pillars that matter most are the hardest to build, Pillar 2 and Pillar 3. So discretion and proportionality are indispensable, and they let the framework fit local realities, and they create the space in which risk, in my opinion, can hide. So a discipline supervisor treats every discretion as a transfer of risk from Pillar 1 to Pillar 2 and ensures the supervisory control that must now bear that risk is actually in place. And let me also add again, let me reemphasize, this is not peculiar to us. It is what we have seen in many of the emerging economies. So, which to let you know that the Basel architecture in terms of Pillar 1, Pillar 2, and Pillar 3 have not matured at the same rate and at the same level. And then when we talk about emerging risks really do not live in capital ratios. They do not lie in Pillar 1. So, and that is why I address the issue of capital and prudential regulation. So when we raise the question, can capital regulation keep pace with emerging risks? The actual question should be, can prudential regulation, for me, can prudential regulation keep pace with emerging risks? Which for me is the right question to ask. So next slide, please. So here we talk about the reforms that the Nigerian banking system have recently gone through. So basically, these are about 4 reform agendas. So between 2024 and 2026, the Nigerian banking system absorbed 4 major reforms in a single compressed window. Now, the first was a steep recapitalization from March 2024, which raised minimum paid-in capital to 500 billion naira for internationally active banks, 200 billion for nationally active banks, and 50 billion for regional and merchant banks, with a deadline of March ending 2026. The second was the full bite of IFRS 9. Yes. So the accounting standard that requires recognition of ECL losses rather than waiting for losses to be incurred. So we had to bring in the full weight and the impact of IFRS 9 implementation. And the third reform was the far-reaching foreign exchange reform, including, we don't call it devaluation, a revaluation of the naira. And the fourth was what some of you may have heard as the exit from regulatory forbearance. So now, why this 4 agenda? Why do we bring it here? I want you to note that any of these reforms, any of this on its own would have been demanding. Now, so however, before reforms were brought in concurrently, and I will also want to announce that these reforms interact among themselves. And often disruptively, if not properly managed. So the 4 reforms, if not properly managed, would have had a disruptive impact on the system. So once, for example, IFRS 9 front loads provision. So once a borrower's credit increases significantly, the bank must recognize losses expected over the whole life of the exposure, and the recognition reduces capital. Please take note. Foreign exchange valuation mechanically inflates the naira value of foreign currency assets, and therefore risk-weighted assets carried against them. So a bank's capital value of foreign currency assets, a bank's capital ratio can fall sharply because of this inflated foreign currency asset. Now, forbearance exit, that program of forbearance, forces recognitions of losses that have been kept off the books, eating capital directly. And all of these 4 in the same window were implemented in the same window, in which banks are spreading to raise capital. So the reforms compound one another and the sequencing risk is real and routinely underappreciated. I think this the system, the practitioners in the system really did not appreciate the effort and the energy put into synchronizing and these reforms at the same time. Now, the outcome suggests that the system absorbed the strain. Yes. So by the deadline, at the end of March 2026, 33 of 37 banks had met that's by end of March, by records available, have met the new capital thresholds, and around 4.5 trillion naira of fresh capital had been raised, roughly 3/4 of it domestically, through right issues, public offers, private placement, mergers, and alongside the orderly exit from forbearance. The system did not break. Yes, capital was raised, transparency improved. I want to invite participants to relate this to what happened in 2004, 2005 Nigeria banking consolidation period, which reduced the number of banks from 89 to 25. The present exercise is in that direction, and the true test comes in the year afterward. So now the point is this: raising capital is the easy half. So raising capital is feasible and finite. A bank issues shares, merges, hits the capital numbers, and the tax is complete. Now, the hard, invisible half, which I also want you to note, is everything capital cannot buy. Raising capital is the first half. As a bank, you have achieved the numbers. That is not all. That is half of it. Now, the second half is, of course, invisible. Is what I say capital cannot buy. A sound risk culture, a capable and independent boards, a living internal capital adequacy assessment that actually shapes decisions, a supervisory function with the skill and standing to challenge powerful institutions. So you can mandate ratios, you can make capital ratios compulsory, but it is challenging and quite difficult to mandate judgment, culture, or skill. Those take years. They take years to build and are the real determinants of resilience. So the capitalization bought a balance sheet cushion. It did not buy better lending decisions, which is not guaranteed. Recapitalization will not guarantee better lending decisions or a more capable supervision. So, in other words, a strong capital ratio atop a weak credit culture is like a strong vote gathered by a careless key holder. So, the moral in this slide for me is that to model the interaction of reforms rather than assessing each on its own, and hoping that the effects sum up cleanly. And well, in our own case, we had it so good, and of course, there are still challenges ahead in terms of what I say capital cannot buy, the risk culture, the bank's internal capital adequacy assessment practices, the risk management practices, and on top of that, the supervisory judgment and other supervisory tools. So next, please. So now, before I tackle the questions, can emerging risks can capital keep pace with emerging risks? I recall that I have preferred that we expand the concept of capital as used in the, by the conference to that we should not restrict our imagination to capital ratios under Pillar 1, and that rather we should look at capital as we have in the conference question to include prudential, or let's say we're looking at prudential regulation. And in that way, we have to reframe the question such that we say, can prudential regulation keep pace with emerging risks? Now, before we attempt to answer that question, I want us to take this magnifying lens. Now, the temptation for any commentator is that in any discussion of emerging risks is that once you're able to generate produce a list of emerging risks such as climate, cyber, crypto, artificial intelligence, non-banks, and then you are able to gesture a few words of concern around each one of them, the job is not done. No, that's a big no. So a list is not an analytical method for looking at the challenge posed by emerging risks. So a list and a drawing of concerns around that is not, for me, an analytical method or analytical solution for the question raised by emerging risks. Now, so I'm going to propose that for each emerging risk, we ask one question in 3 parts, and this is it. For each emerging risk, is this emerging risk, is it a Pillar 1 problem? Can it be captured in a credible capital numbers? Is it a kind of quantifiable loss distribution shape risk the formula is built to handle? That's the capital ratio formulas. Or is it a Pillar 2 problem, which is a matter for supervisory judgment, scenario analysis, oversight, scenario analysis and oversight, rather than for a mechanical capital number under Pillar 1, because it is forward-looking? Or does it lie beyond capital altogether? It lies within the domain of liquidity, what we call operational resilience, resolution, or the perimeter. I'll soon talk about the perimeter risks now, where no amount of capital is the right answer. So what is the right way, right method to tackle emerging risks, which clearly is not about coming up with a list of the emerging risks and scripting some concerns around that. So now, what is the right method? I believe the methods, the assumption that response to any new danger is to require banks to hold. That is, for me, is dangerous. That, okay, for every new risk, the response should be to require banks to hold more capital. That assumption is a dangerous one for me. So capital is powerful, of course, and is appropriate too for some risks, and a clumsy, even counterproductive one for others. So applying a capital charge to a risk does not fit the mode. A forward-looking, behavior-driven, or deeply uncertain risk produces false precision, can double count exposure already captured elsewhere, and divert attention from the tools that will eventually help. So the reason the lens which we have to magnify the problem, the reason the lens matters so much for emerging risks specifically is that the frontier risks, these emerging risks, tend to have exactly the features that make capital a poor fit. So their features make capital when we ask banks to provide more capital. Actually, because of the essential features of this emerging risks, that will make capital a poor fit. Now, what to take from this slide, before I move on to the next, is that is a statement about the proper scope of capital as much as a sorting device. It is repeated lesson applied across those emerging risks, climate, cyber, crypto, artificial intelligence, non-banks, perimeter risks, is that for most of the frontier risks, the honest answer is pillar 2 or beyond. And recognizing this, rather than reaching for new capital charge each time, is the disposition of the supervisors who understand the limits of the capital instrument. So now, so therefore, in treating or in addressing the issue of capital and emerging risks, these 3 questions have to be asked and answered. These questions have to be addressed. We ask, is it a pillar 1 problem, or is it simply what a capital ratios or more capital can address, or is it a problem pillar 2 can solve because of the capacity of supervisory judgment, or because through scenario analysis and oversight, it can best be fitted into pillar 2, or is it beyond capital itself? So I believe in addressing emerging risks, we should look beyond the capital ratios and raise these questions. Next slide, please. Now, let's look at the nature of these emerging risks. Next slide, please. So climate and extreme weather are real, they are large, and most times they are unavoidable, but they are a poor candidate for dedicated pillar 1 capital charge. Why? There are not enough data. The planning horizons involved are long. They represent events that not occur frequently, and the risks involved is forward-looking. In a way, a capital formula calibrated on historical losses cannot capture. So the appropriate tools, therefore, are scenario analysis, pillar 2 and disclosure. And Basel Committee's own work has focused on financial impact of extreme weather events and the role of insurance rather than on inverting a climate risk weight. Now, digitalization and artificial intelligence sits largely beyond capital. They raise the issue of opacity. They are not fully understood. And the issue around third-party and cloud concentration risks are also present with artificial intelligence, even though we attempt to address that by governance, model risk management, operational resilience requirements. For cyber risk solution is resilience first, because the loss data-driven operational risk charge structurally under captures rare, severe, never before seen events. One cannot sensibly hold capital against a ransomware attack that freezes a core banking system for 3 days, for example, where what saves the bank is tested backups and rehearsed recovery. So within the essence of climate digitalization and cyber risks, clearly they are out of pillar one. We may have to look at certain pillar two risks and pillar three, which is market discipline through disclosure, and then some of Basel's own work, which focus on impact extreme weather events and the role of insurance rather on inverting risk weight. Now, for crypto digital runs and non-banks, crypto assets are the only one where from experience, we can say sit squarely within pillar one. That's a crypto asset. And they are like about the only exception to this. So the risk is new, it's emerging, of course, but quantifiable for crypto assets. And the Basel Committee has written a bespoke conservative standard effective from the start of 2026 that aligns tokenized traditional assets and qualifying stable coins with the underlying or existing rules, while subjecting the riskiest unbacked crypto assets to punitive treatment, including a risk weight that effectively requires capital to equal the value of the exposure. And that's where we apply the 1,250,000% risk weight. So of the major emerging risks, only one crypto asset sits squarely in pillar two. And even the response is conservative, and it's not, and the response can even keep pace with the movement in this risks, this crypto asset. So the rest are scattered. The rest of the emerging risks are scattered across pillar two, what we call operational resilience, liquidity, and the perimeter risks. I'm coming to discuss the perimeter risk. So the accumulating pattern, the pattern in all of this, rather than any single placement that, okay, you can place any of these emerging risks in any particular bucket in this architecture, is in principle core of my eventual verdict, which I'll be giving at the end of the presentation. So capital regulation cannot keep pace with these risks because most of them are not capital problems in the first place. So looking back at the conference question, can capital regulation keep pace with emerging risks? Many of these emerging risks, if you apply this these three questions of whether they relate to pillar one, whether it is a capital problem, capital adequacy problem, whether it is pillar two, where supervisory judgment can address. It is not straightforward. These are not straightforward. So of the major risks, in conclusion, one, which is crypto assets, sits squarely in pillar one. And even the response, what we have gotten from the Basel Committee is conservative. So the rest are scattered across pillar two, operational resilience, liquidity, and the perimeter risk. So the defining pattern here rather than any single placement is the empirical core of my verdict. So capital regulation cannot keep pace with this risk because most of them, I repeat, are not capital problems in the first place. So what we may have to do then is asking honestly of each of these emerging risks whether capital is the right tool, and noticing how rarely the honest answer is more capital. Well, which is the temptation. So for each risk, the supervisor should ask, if this risk happens tomorrow, if struck tomorrow, will additional capital have saved the institution, or will something else, such as a tested resilience, stable funding, an extended perimeter, sharper supervision, any of that have done the work better? So the answer in almost every case of this emerging risk will point away from capital ratio. So next slide, please. Now, let me talk a little bit about risks beyond the perimeter. So how risks are migrate not just across borders nowadays. The migration, we have now seen that risks migrate into non-bank finance, and the migration of risks into non-bank finance is the strongest single reason capital regulation. Yes, one of the reasons cannot keep pace alone. Capital regulation cannot keep pace alone, and this lag in reacting is structural, not born out of any negligence. So it is structural, that it is inherent in any rule-based capital system, rather than a failure of drafting. So now the waterbed effect. The non-bank. What are the non-bank financial institutions? This time has largely replaced the older shadow banking, which we used to make sometimes. So, and the term now covers entities that perform bank-like functions outside the regulated system, such as investment funds, money market funds, private credit vehicles, insurance, pension funds, and family offices. Collectively, they now account for a half of all global financial assets. Now, quoting a reference from the BCBS webpage. So the central image here is waterbed. So a waterbed, when pressed down in one place, water bodies up in another place. So if you tighten bank capital, that is, make bank lending more expensive in terms of capital, and the risk does not disappear. The risk will not disappear. It makes lending by bank in that area more expensive. It migrates into less regulated non-bank space where capital rules do not match. So when more capital punishes bank for engaging in certain businesses, banks tend to drop that type of business, and then you see those types of business coming up in other non-bank financial institutions, for example. And when you look at the connection between these non-bank financial institutions, many of them are still they still form large bulk of the clients, the bank customers, and especially the loan customers. So they form part of the risk portfolio of banks. So the risks have moved from the banks because of punitive capital requirement. You require banks to hold more capital to keep on doing that such kind of business. So they tend to drop that type of business. And then you have that businesses being taken over by non-bank financial institutions. Why? Because there's less regulation, there's less supervision in that space. So, and this is what we call the waterbed effect. But meanwhile, the risk has not disappeared. It has only shifted from one hand to the other through this perimeter that divides bank from non-bank financial institution. And now, when these risks crystallize in the portfolio and the balance sheet of this non-bank financial institution, which are borrowers of the bank and the regulated institution, what happens is that the banks are ultimately faced with this risk exposure. So actually the risks do not go away. So the risks only change spaces, move from one space to the other. So why capital rules cannot reach it? So bank capital rules can only capitalize bank exposure to non-bank sector. So it can only capitalize the exposure to this non-bank sector. The loan a bank makes to a fund, for example, the credit line, the derivatives it transacts with that non-bank financial institution, they cannot capitalize the risk that has migrated in the non-bank entity itself, because that entity is outside the scope of bank regulation. Yet the non-bank sector is frequently funded directly or indirectly by bank, so that the risks that has left regulated core banking remains connected to the banking units through funding chain. So tightening bank rules without addressing the perimeter, therefore, does not remove systemic risk. It only relocates risks to a place where supervisor cannot see clearly and reach at all. So this is a fundamental problem of regulating entities by their legal form, when what we should be doing is to regulate activities by their economic substance. So now, let me also bring up the event of the Archegos Capital Management in Manhattan, New York. It was a family office business. The Archegos Capital Management built up enormous leverage exposures in the order somewhere around 160 billions through total return swaps provided by a group of banks, each of these banks saw only its own slice. So they did not see the other banks' parts in this funding. So when the position turned against Archegos Capital Management, Archegos could not meet its margin calls. The losses detonated inside the banks, right on their balance sheet, in their books. The losses exploded, even though they had not directly taken on these risky ventures. So another example is Credit Suisse, which we had earlier mentioned. Credit Suisse alone lost more than 5 billion to Archegos Capital Management. So, and in the UK, the United Kingdom's liability-driven investment episode of 2022 told a structurally similar story, where leverage embedded in pension fund strategies nearly broke the market for government bonds and required emergency central bank intervention. So in that case, exposure elsewhere can find their way into the banking system. So this is the stronger reason capital regulation cannot keep pace on its own, because it is a matter of scope, not of calibration. So no better risk weight can fix it. So the answer lies in extending the perimeter, regulating activities, improving data on other sectors, and coordinating at the level of the Financial Stability Board. So next, please. Next. Next slide. So now that we have this realization before us that capital alone cannot keep pace with emerging risks, do we have to despair? I don't think so. So because the response to the limitation of capital rules should not be despair, but we should have a separate type of different toolkit, which is a set of instruments that sit largely outside capital ratios and that are between genuinely capable of keeping pace with emerging risks. Now, Pillar 2 acts as a shock absorber for Pillar 1. That's those risks that cannot be modeled by Pillar 1. Pillar 2 takes care of them and allowing supervisors to require capital and action against forward-looking and bank-specific risks through judgment rather than formula. So now, one of the the toolkit we need to have is stress testing and scenario analysis for addressing emerging risks, including reverse tests and exploratory exercises on climate and cyber risks. We should be asking questions under that scenario, that stress testing and scenario analysis. We're asking what if rather than what was. So which I believe the honest way to regulate a risk with no history. And of course, this is the essential feature of emerging risks. They do not have history. So we ask, we need to start asking, what if this happened? Not what was. So through stress testing and scenario analysis, we'll be better equipped at addressing emerging risks. Then through the adoption of operational resilience framework, which is another tool, which we set impact tolerance. We provide limits on how critical service may be unavailable and require testing of recovery capability. They are the right tool for cyber operational resilience framework. Now, another tool is macroprudential buffers, including counter-cyclical buffer, sectoral, systemic risk buffer. These act on the system and the cycle rather than single firm, addressing procyclicality and concentration. And talking about perimeter risks, another tool, perimeter extension and international coordination through bodies or committees, the formation of committees such as the Financial Stability and to address the waterbed effect, and then a set of supervisory technology and machine readable reporting. So I believe these are required tools for addressing So emerging risks. So we have a stress testing and scenario analysis where we need to ask the right questions, and then we also need to institutionalize operational resilience framework which sets impact tolerances, provide limits on how long a critical service may be unavailable, and require testing of recovery capability. Then macroprudential buffers, which includes counter-cyclical buffer, sectoral systemic buffers, and then perimeter extension and international coordination through bodies such as committees, financial system stability board, or financial system committees, and then a whole set of technology, supervisory technology, and machine readable reporting that compress the speed mismatch by giving supervisors data in real time. So now running through all of this is a single organizing idea. Running through all of these solutions which I profile before you is one single organizing idea, which is a risk-based judgment-led supervision. So it is the institutional answer to the fact that capital rules cannot foresee everything. So when the rules books runs out, especially against emerging risks, and it will always be so, supervisory capability and judgment must take over, identifying emerging vulnerability, forming a view about it, and acting before it has a loss history from which a rule can be written. Now, the honest difficulty or challenge with this is that judgment-led supervision is demanding, and building one is demanding. So it requires skilled, well-resourced supervisors with the standing challenge, with standing to challenge powerful institutions, the data to see risks early, and institutional backing to act on contested judgments. These are exactly the capabilities that are scarce, especially in emerging markets. Next, please. Now, I'm going to provide my opinion, my verdict. Next slide, please. So this is my next slide. Okay, now before this, the slide before this. So this is my position with respect to the conference question, and the question is taken from the theme of the conference, which is, can capital regulation keep pace with emerging risks? Capital regulation cannot keep with pace with emerging risks. That's my position, my verdict. Capital regulation cannot keep pace with emerging risks on its own, and it was never engineered to do so. So it must be balanced immediately. So Basel III finalization is a sound, comparable foundation. The Apple floor restore trust in risk-weighted assets and close the post-crisis agenda. The capital framework is necessary and is being defended, not attacked. The claim is not that capital does not matter, or it is no longer where the marginal or emerging risk sits. So a participant in this conference who hears capital cannot keep pace and concludes that therefore capital is unimportant has misunderstood the whole argument. The correct inference, in my opinion, is that capital is necessary but insufficient, and that attention and resources should flow towards the part of the prudential system where the unaddressed risks lie. So emerging risks sit outside Pillar 1. Most of the emerging risks sit outside Pillar 1. Crypto assets, to a limited extent, sit within Pillar 1. And when we are to address emerging risks, we have to widen our scope of capital regulation to include prudential regulation. And in honest facts, capital regulation on its own, capital regulation is important, is essential, but on its own, it cannot keep pace. So supervisors must come up with certain essential tools which must be at their disposal, such as stress testing and scenario analysis, build competency in that area, develop and implement effective operational resilience frameworks in the system, and also, come up with macroprudential buffers, which will include counter-cyclical capital buffers, and then perimeter extension. It is necessary because risks now are migrating from banking units to the non-bank financial institutions. And meanwhile, when these risks, when they crystallize, they resonate in the balance sheet of banks. So we can't lose focus of what happens in other non-bank financial institutions. So we must have a way or a system by which we monitor events or happenings in that space. And then the last but not the least is that supervisor must also come up with a set of supervisory technology, machine readable reporting data, which are for the purpose of meeting the required speed by giving supervisors data in real time to support supervisory judgment. So that is my verdict. Capital regulation cannot meet on its own, cannot keep pace with emerging risks. And what is the way forward, especially for us on this side, is that for us, our supervisors, and that has defined our current approach to emerging risks. So therefore, we have begun a set of implementations, and I believe the system will begin to see many of these methods, tools, and other approaches being rolled out in the year ahead. And of course, we're just rounding up with the recapitalization. So on our side, we'll be investing more in Pillar 2, developing capacity in Pillar 2, especially risk-based supervision and supervisory technology. You may come to see a change in very soon the way we conduct our risk-based supervisory methodology. The work is in the pipeline, and soon it will be finalized. And then also in terms of supervisory tools, some have been deployed. How we connect with required data from the banking, the entities. So we have this. So overall, we're moving towards towards properly addressing this novel emerging risks. And I believe I have done justice to that task set before me by the association and the conference. Thank you so much. So we'll be willing to take any question from any participant. Thank you so much. So over to you, organizer.
Wow, 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 wow. Honestly, wow, 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 wow. Wow, this is real. Wow, Dr. Fashipe, you can see all the applause. You can see them. You can see what is happening, Dr. Fashipe.
Thank you so much.
Thank you very much, Dr. Fashipe. Thank you very much. Thank you very much.
Thank you,
Thank you very much. Really, really, really. We can't really thank you enough. You understand? Right. All right. Wow, we appreciate you.
And I've also provided some posters for the participant to also
yes,
take home with them. I did
yes.
3 questions there. Yes.
Oh, yes, yes, yes. In fact, this time around now, please, we want to change the pattern of the conference. So rather than having another time for panelists and whatever, that kind of thing, because we noticed that today is the first day of the month, right, of July. And honestly, it has affected a lot of people, especially the regulators. All of them, we are in contact, and whatever. Please, we have meeting. We join you in a few minutes. We have meeting, but up to now, you understand. I mean, they are still going to join, but so we are not going to have that panel and whatever, right? So what we are having now is question and answer session. Please, the other panelists, Tamme, right? Tamme and the other guys, please, we want you to be attentive, right? That is the beginning of the panel, right? So we are not formally setting anything up again, right? So it's you are free. Everyone is free, please. You can ask questions. You have listened to the presentation from the beginning to now, right? So please, this is an opportunity to have an interface with Dr. Fashipe from the Central Bank of Nigeria. Please utilize it very well. This is the house of Basel by the special grace of God. So please, let's be free. Let's be free. We have a lot of people here. You understand that, right? So the panelists are there, right? So please, it's time for us to just ask questions so that they can answer, and we'll be able to save time. I hope, definitely, I hope I'm permitted by the chairman, Alaji Kwaranga, to say this, to alter this thing. You understand, so that we can save time. Thank you very much. So question time.
Thank you, sir.
Question time. Thank you, Dr. Fashipe, once again. Thank you, thank you, thank you.
Thank
question
you,
time. You are busy by.
Good day, Dr. Fashipe.
Good afternoon.
Good afternoon. Last year, when you came to deliver the first Basel Accord Day, you said that the CBN wanted to employ some Basel specialists.
Yes.
How many have they employed now?
I know that there has been a kind of retooling in the committee that handles the CBN's Basel program, and then there have also been some additions to the committee. So, but essentially, what we wanted then was to have this committee transform into something like a because as a committee, his work is run on a part-time basis. So they come together and they try to address provide solutions to challenges of Basel implementation in the system. They come together, but our expectation originally, and I believe management is going to look in that direction, is to have a standby unit that will be available to look at or take on any challenges and address any issues relating to Basel implementation in the industry. That's just like what I said in the last slide on a real time basis, so that we can reduce the lag between reaction or event and supervisory response. But talking about numbers, the numbers employed, I may not be able to give you. I think that would be left for the HR department to say that.
The reason why I'm asking, I suggested
Mm.
that day that you should
Okay.
firm up a deal with AERMP to train some of those Basel specialists for you for CBN. That's the reason why I'm asking.
Right.
So,
Let me just come in. Thank you, Ellen. Let me just call in. Ellen, I discussed this thing with Dr. Fashikwe before. Oh, please, they are calling from NDIC. Please, a minute, please.
Okay.
all right.
Okay. Thank you very much. I'm sorry. We've been in touch with the managing director of NDIC. He's been in several meetings. You understand, right? Maybe the next one we are going to do it. We won't do it probably on the 1st, but we have to do this one on the 1st because this is the Basel Day globally. July 1st is recognized as the Basel Day. You understand? That's why we are doing it today. But for kind of convenience reasons, we may shift it to other days, while also taking care of reserving that date. Right. So sorry. Just what I wanted to say before. I discussed something with Dr. Fashikwe, but definitely we still have a long way to go regarding that. That by the grace of God, we are going to have the first set of Basel Accord, you understand, the professionals, you understand, that will be certified, right? We are going to work, that's our intention. I just discussed with him, last year, right? But one way or the other, there were other things, so we were not able to start. But even this last month, we have discussed it in the office at the AERMP that by special grace of God, by next, between now and the next year, in fact, our initial target was December, you understand, but it's like December may not. We still discuss with Fashikwe and others at the regulators area there, right? So, but we are knowing it now officially that we are listening to it. So we are going to have, to develop consciously the first set of Basel certified professionals in this country. You understand, right? Of course, we cannot do it alone with the regulators and whatever, but now everybody is hearing, you understand, and by the grace of God, we discuss later with Dr. Fashikwe so that we can start, this thing, right? So that's just to answer your question, our Eileen Atohegbe. Thank you very much.
Thank you.
Yes,
Then secondly, I want to ask another question, Dr. Fashikwe.
Okay.
What are you doing about
Okay.
regulation in the crypto industry? Because there are too much fraud in that place. It's like as if there is no control at all. What is the Basel Accord doing? The next one they might want to do. What are they doing about it? There is no control in that place at all. No control. They do whatever they like.
Okay. So let me your first issue with relating to plan training program for CBN supervisors. I think just like Professor mentioned, I recall we had a discussion on that some time ago, but then it's still the same position I'll be taking, which is, I believe, is a formal position that you have to still make a kind of presentation to the department or directory. You can probably, of course, through a submission, you make a submission, and in that you're going to have introduce your faculty, indicate their competencies and core areas and other things, and probably also see how you can contact the director of banking supervision on that. So I think that is how others have been going about it. But let me also add now that the expectations of the bank is relatively high. So because it's been realized that the matter contained within the context of a Basel implementation, or what we call Basel Accord generally, may not easily lend itself to everybody's comprehension. You understand me? So that on this side, and this is my opinion, this is not the position of the bank, is that we won't be requiring a kind of higher level capacity building such that disciplines are developed in core areas of Basel. For example, in areas like interest rate risks in banking book, or you talk about modeling or ECL modeling or modeling risks, forecasting and things like that. So rather than coming to the basic and rudimentary context of capital accord. Do you understand what I'm trying to say? Yes. So we so the expectation is high up there. So in terms of what we want to achieve when it comes to capacity development. So so that's just some hint from me to you on that. Then your next question on the I answered the first one, which was about the number. So the next question on the crypto, right?
Yes.
Hello.
Yes, sir. I'm hearing you, sir.
So the next question on crypto is that the CBN has already long before now taken steps to address that. And if you recall, sometimes and that was pre-2023, there was a directive that no bank, in fact, banks were advised not to go into or to fund or finance crypto assets. That was pre-2023. So, but now I believe the bank is taking a different posture. And recently, a department has been formed to take charge of that area that includes exposure to crypto assets. So if we have a department now, and that is I think it is called Payment System Supervisory Department or something similar to that. They are in Abuja, so and they are working. So CBN is moving from a kind of a restrictive posture to something less restrictive. So we want to take a kind of measured approach to bank exposing their balance sheet to crypto assets. So, and that is exactly what is going on around the world. And then for the incidents of risks happening, recall I mentioned issues like perimeter risks, where certain risks are now migrating from banks' balance sheet into non-bank financial institutions. So nowadays it will be difficult to say that this bank is exposed to crypto asset risks, or this bank is unduly financing. You can have such example today. you can't have it. So if you're looking at for crystallization of crypto asset risks, you'll be looking at the non-bank financial institutions, not in the core sector.
Okay.
So we're seriously on it.
Okay,
Seriously
sir.
on it. Mm.
Then thirdly, something outside this conference.
Sister, Mrs. Ellen, please, because there are other people, you
Okay,
understand, right? So
Let me.
Okay.
Okay,
thank
let
God
me.
there's something outside. We can take it after, you understand?
Okay,
Right?
well, I want to give Dr. Fashikwe one assurance that AERMP
Okay.
is more than capable to train your Basel Accord.
Yes, I'm not disputing that. I'm only telling
Yes.
you
So you just help
where
us
the
to throw in the
expectation.
words. That's why
Ellen,
we
no
know
problem.
you.
We will take it
Okay,
over
sir.
from there.
All right,
Dr.
sir.
Fashikwe is also a fellow of Enterprise Management Profession. Apart from that, and in addition to him, we have some chief risk officers, that are well trained in Basel. Apart from that, we have international facilities. So don't forget that AERMP is an international institution. We are just a kind of headquartered in Nigeria. You understand? So we take care, all of those things, even in this session today, in the conference today, we have nothing less than about 4, you understand, foreigners, or 4 or 5 foreigners with us, you understand, from different parts of the world. So no problem, we take it. It's a very good and interesting thing, but don't worry, we will, discuss it further and take it up from there. Thanks so much, Ellie. Imoeko Stephen Aigbe, you are asking a question, or you are raising your hand. Imoeko Stephen Aigbe.
Good afternoon, sir. Can you hear me, sir?
Good afternoon.
Can you
Good
hear
afternoon.
me, sir?
Good afternoon.
Faintly.
Quickly, please.
Please, you pardon my curiosity at this time. From what CBN has just submitted.
Please, louder, a little louder.
Yes, I'm not also hearing him at all.
Can you bring that louder?
How many of the money in circulation can CBN account for? As in those that they are printed and those that were not printed, those that were recovered from fraud, those that were imported from abroad. How many of them?
Let me understand that question again, please. Take that question, please, again.
The money in circulation, how many of it can CBN account for? How many of the money that were repatriated have been accounted for in our circulation? Because he made mention, he gave an example of a bank that went down in 48 hours. If such bank can go down in an organized or well-organized economy, our hours, I don't know what we can call it. If money collected from Abacha loot, I don't know how many of it will have been accounted for.
Excuse me, sir.
Yes, sir.
Excuse me, sir. I'm sorry, sir. Mr. Stephen Imoeko, you understand? I'm very sorry. I appreciate the question, and but this is Basel conference. You understand? I'm not acting on my own. We have a team, and the team said I should actually get back to you that it's Basel conference.
I'm not hearing it again. No.
I'm here. Oh, check your system. I think I'm clear enough. You understand, sir? Right. So please, what I'm just saying is that
I'm hearing you now.
You're not hearing me, Dr. Fashikwe. Are you hearing me, sir?
I can hear you.
We can hear you very well.
Thank you very much.
You,
so Mr. Imoeko Stephen, please, let us look at, we have been talking about Basel Accord, right? Please, let every question that we actually we are asking today, let it be around that, you understand, so that the purpose of the conference will be fully achieved. You understand? Please, let's limit it to the Basel Accord implementation, implication of Basel, what kind of risk can Basel cover, what is the challenges of Basel, and however, you understand. Thank you very much. I appreciate you. And you can also get back, after, you understand that kind of thing, so that we can, our chairman is here, and he has told us that we should manage the time very well. Thank you. Mr. Olugbele Eriwusi, our director of capacity building.
So,
want
Prof,
to say something, sir?
Prof, let me, Prof, before the next
okay,
question,
sir.
let me add this.
Okay.
I think the last speaker was trying to have a sense of according to, let me just quote him. He said currency circulation,
In
sort
circulation,
of.
yes.
And I also mentioned the issue of Silicon Valley Bank. So
Oh, yes, sir.
These are not connected events. Now, for the currency in circulation, that information is publicly available. If you just go to the website of CBN, www.cbn.gov.ng, you can pick the last audited financial statements of the bank. And as at the last period, I think the currency in circulation is over 5 trillion. It's over around 6 trillion naira, or thereabout. And I will also let it be known at this point that currency in circulation, just like the word, is currency in circulation. We're not looking at other monetary aggregates like what we call the was the monetary aggregate of M2, M1. So, but then you have all that information available, publicly available in the official webpage of the bank. Then the second matter, which is on how the bank, Silicon Valley Bank. Silicon Valley Bank was a peculiar bank. The bank had over $200 billion, 200 billion assets, $1 billion assets on a Friday, and the bulk of the bank customers are these financial technology, big technology firms, and so when it comes to technology sophistication, these customers are there. So the bank was alive on a Friday. By Monday, the bank was gone. What happened? This is what we call capital cannot match that. This is what we call a kind of social media bank run. The bank had issue with his accounting record. That was not enough for the bank to die. So there was a kind of a mismatching between the US government allowed what we call the OCI filter. So there was a kind of mismatching between the OCI filtered on the balance sheet and the bank's capital, whereby the revaluation losses were not moving directly into the capital. And what happened was that the customers got wind of this. And because these are, when it comes to technology, using the social media, these are sophisticated customers. And that was exactly what happened. The information leaked, and then the news spread fast, very fast. And then same day, that lost over 40 billion. It's not about coming to the branch to line up. There is no queue in the front of the bank or any of the branches. There's no long queue, nothing like a queue. You simply log into the system, move their phones. And that was what exactly happened. And that's the type of risks I refer to as a technology bank run. And there is no amount of capital that can prevent that, because that's also an emerging risk. It's different from the kind of bank run we used to see back in the years. So now, when such bad publicity is published, made known about a bank, social media matters a lot. It spread, and that was what happened to SVB. So that is about for Mr. Imoken Stephen Aigbe. Thank you. Next, please.
Thank you very much. Thank you so much, Mr. Olugbile, Director of Capacity Building, please.
Yes, sir. Thank you so much, sir. Good afternoon, everyone. And I want to just raise a comment. First, to thank Dr. Fashipe for the very insightful paper. which I know a lot of us that are operators and practitioners, we've drawn high-level knowledge from this paper. But just few comments that I want to put forward, which I believe also should help us, even as an industry. From the paper, it's clear that Basel is a guideline, it's not a regulation, and that's why different jurisdictions have that liberty to be able to do a tweak. And just like you showed to us at different areas and here and there. But in summary, takeaway for me, just like we've seen that capital regulation is not the answer to emerging risk, and it's very clear. Because the day CBN even did something recently now to say after you've closed out on your capital gap as at end of March, stress test and assume that you even have this level of loss, and let's see whether your capital adequacy is still sufficient. So we saw it clearly that even that little stress test still declared, it opened up a lot of insight into several areas. So I think the bottom line is for us to be able to take some closer view around more collaborative approach, because just like it showed us in the European world, in the UK, even in America, everybody sits down and they look at what can really work for our environment within our jurisdictions, so that operators and regulators alike have a lot more collaborative approach in taking on board this concept of managing risk. For example, Basel guideline, all of the time, a lot of releases come up to still provide a lot more guidelines to the operators. But we have responsibilities within various jurisdictions that we find ourselves to be able to collaborate more. I think in our jurisdictions, we need to do more in that area. And because the summary of this paper is extant, it shows us that there's no volume of capital that you are raising that really provides cushion for emerging risks. Because once there's a crystallization of risk, the rest will just become story. The other point that I also still see also is embedded discipline, honestly. Because, for example, today you raise capital, and like Doctor said, does that solve the problem of lending, credit risks? Even the application of that capital, what is the level of governance that drives it? And even on the side of embedded discipline, supervision also, just like you mentioned on the SUREP side. So it still speaks to a collaborative approach in just making sure that the wonderful guideline in the Basel can really solve or help us in a way, to a large extent, to hedge some of these things that we face all of the time. So, but because the level of collaboration, you see silo approach to so many things, sometimes rule-based, you just have to get some level of compliance and then you move forward. The Institute create this platform for us to be able to see clearly, and just like when you started your introduction paper, this is not CBN speaking, this is you, and then we have seen a lot of insights into the need for us to be able to operator, regulator, have that level of collaboration. The other point for me also is a lot of transparency in the models that we use, because we can't walk away from models, and you've shown us also. When you talk about tooling, talk about stress testing, talks about, but to what extent, what are the strengths of the framework that really drive some of these models? And then what is the governance structure that built into the back testing to tell us that these models are really predictive enough? And then we can take the right decision to be able to edge some of these risks from crystallizing. In a nutshell, for me, we had a wonderful session today. We had a wonderful paper. And I'm sure the registrar and the president of the institute, we enable us to be able to drop a lot of inferences from here and also make representation to our regulator in a way that we can take this topic, and of course the Basel week, to really be something that is pivotal in the way we're able to effectively predict and then manage risks in our jurisdiction. So thank you so much, Doctor, and thank you, everyone. Thank you, Chairman, everyone. Thank you.
Thank you, sir. Thank you, sir. So let me pick this word in your comments. These two keywords. You mentioned collaboration, and you said some things have been done in silos. Yes, to some extent, but I believe, and I will also try to make this as a kind of my bit of how do I say it now? I don't want to sound. Let me just make this a bit of advice. Put this before the association and the executive team of the association. Now, because clearly that collaborative aspect really, especially that one that will bring the regulated entities and the regulators together. I think it's high time we got something working in that direction. So, and I feel that an association, a professional body like ours with focus on risk management can champion this cause. We can have a kind of a ad hoc committee, sort of, or come up with regular programs, especially on issues relating to Basel implementation or this emerging risks, whereby you have maybe the CROs of banks and then the regulators coming together, even if it is going to be a one-day program. So the body can champion this. You can have like a AERMP committee for banks, CBN on risks, on prudential regulation, on you understand, and through that there can be a kind of collaboration. So you and the banks will better understand some of the policies that are coming from CBN, and then the CBN too will also get to take the post directly from the banks through those kind of forums. So it's good. Prof, you are beginning to think about this. So maybe you expand your mandate to cover things like this. And I believe that we achieve buy for you more relevance within the Nigerian financial system. So,
thank you very much.
Thank you so much.
Thank you very much. All noted.
So yes, I believe so. I believe so because I know there's a we used to have this forum of I don't know how strong that is now. Is it the CROs and CBN? I know there used to be a regular meeting those days, but I doubt if for the last 2 years if there's never been anything regular again. But then can be picked up from there.
All duly noted, Dr. Fashikwe. Thanks so much.
Okay. Thank you, sir. So next.
Next question, please. Next question. And like I said earlier on, a question some to Dr. Fashikwe. Other ones also can go to the earlier presenters. That is Tanmay is still there, and the other guys are, from a different part of the world. You can, if there are questions, questions, you can actually chip it in now. All right. Let me use this opportunity to quickly make some recognitions, right? There are some dignitaries that have been with us, some of them have been mentioned, but some have not been mentioned. Let's recognize the presence of Alhaji Tijani Borodo, immediate past president and chairman of Governing Council of the Chartered Institute of Directors. Alaji, I appreciate you. We appreciate you on behalf of the President and Chairman of Council. We appreciate you. Mrs. Elizabeth Agu, former Director of Central Bank of Nigeria and former resident Electoral Commissioner of INEC in Anambra State. She's an MNI, MNI. She has attended the prestigious National Institute of Policy and Strategic Studies, NIPSS. Understand? So thank you so much, madam. Some of them, all of them were here, but maybe some are not here again and whatever, but they were here. It will be on record that we recognize them. Professor Miriam Abdul of Kaduna State University. Right. Madam, we appreciate you. Thanks for coming and being present almost throughout. Professor Kabi Tahir Ahmed, Barrio University, Kano, we appreciate you, sir. Madam Pamela Uzomoka Pamela Robert, Director of Enterprise Risk Management, NDIC, you are welcome and duly recognized. Dr. Mrs. Folashade Adegboye, HOD Banking and Finance, Covenant University. Madam, you are welcome. I know that as at now, a lot of things are going on there, interview here and there in Covenant, and still you are able to make this. A lot of presentations that you have made today. We really appreciate that. Professor Ochei Ikpefan, also from the Finance and Banking Department of Covenant University. Right, we really appreciate you. We know the challenges you are facing there. Presentation, but for joining, we really appreciate you. And also Professor Kehinde Adetiloye of Covenant University Finance Department too. And also Mr. Francis Adekunle Agbola, former director, NDIC Academy. We really appreciate all of you. And it's exciting that there has been someone, the president of, Professor Miriam, we thank you, Professor Desiloye. When you people are not saying I thought that maybe you have left. Professor Miriam Abdul, thank you. Professor Desiloye, thank you very much. I appreciate you. And really want to really appreciate the Chartered Institute of Taxation of Nigeria. Their president, maybe he just left, maybe minutes ago. He has been there. Sorry, the thing threw me off. Sorry. Thank you very much. All right, so you can just go on with the questions, please.
That's also part of emerging risk.
We have promised the chairman that we are not going to overshoot the time. Right, so we are trying to make it up. Right, so please, questions, so that we'll be rounding up. Question and contribution. question and contribution for Dr. Fashikpe, Tamme, and others?
Good afternoon, sir.
All right.
Good
Question and
afternoon.
contributions. Okay, there's one question on the chat, I guess.
Good afternoon.
Question.
Good afternoon. Hello.
I don't
Hello.
understand. I've gotten back to you. So is there going to respond to that, mate? On the others, that others sheet, I just took 5 million and above. I look for me 81%. So only Umveka court and can't be separate sheet. When you go delete, I want to another.
Sorry, who is that?
Hello.
I think he should be muted, please. Look, Bela, thank you very much. I appreciate. So, Registrar, where are we? Has Fasipe responded to all the questions and the clarifications?
Yes,
Alaji?
sir. I'm waiting for more questions if there are any.
Yes, more questions.
Correct and impressed.
I'm waiting for more questions if there are any.
Good afternoon, sir.
So, I think some people are trying to ask questions. So,
good afternoon, sir.
Please let's have the people that want to ask questions to raise so that we can see the side, so that we can allow them to ask the questions. So that we can have one
Mr.
conference,
Chesson.
please.
Good afternoon, sir.
Afternoon, go ahead, Mr. Chesson.
Okay. Actually appreciate Dr. Fadik for that impressive analysis and declaration. The question I just want to put, of course, put into consideration that one of the emerging risks here, which we have actually been talking about in terms of technology in respect to digital and AI. My point is this, and from what you have said, because I actually listening despite the tight schedule I have, from some of the things I've said, that capital is not necessary. It's not necessary. It's necessary, but it's insufficient to cope this. And most of the emerging risks actually fall out of the pillar 1, which actually focus on capital. My own question is this: looking at AI-driven cyber threat, which is also said that it goes beyond capital. What are those strategy or model that we can put in place as an organization or institution to actually mitigate and bring or reduce, or if not eliminate, this kind of risk? Thank you, sir. Over to you, Mr. Fadipe, please. Dr. Fadipe, sorry.
Oh, okay, sir. Okay. Now, thank you so much. So you asked as an entity, what are those measures you can put in place against the threat of AI, right? Hello.
AI-driven cyber threat.
Okay, AI cyber threat.
Cyber threat.
Okay.
The fact that it goes beyond capital, based on
Okay. Yeah, yes. Clearly, my submission, and that's my position, which I said at the beginning, will not may not reflect CBN's position. This is my position from my study, and is that emerging risks, of which we have cyber risks, is many of those emerging risks clearly fall outside the zone of pillar 1. And how do you address them? Now, first is that I spoke from the perspective of a regulator, and that's why I had to arrive at a verdict at that position. So because you asked, and I'm going to assume that you represent a financial institution. So I'm going to say that well, part of the solution I provide may also work for you and your organization, and this is it. So clearly, these risks are not their essence, the features of these risks are not what capital can answer. So it's clearly beyond the scope of Pillar 1. Even if you have to extend the concept of Pillar 1 to that of prudential regulation, it is clearly outside the scope of Pillar 1. So it's not a question of raising more capital and that you will adequately address the question or the emergence of any novel risks. No. So, and I said, and I want you to note this, I did not say capital is not important. Capital is important. Pillar 1 regulation is important, but it is not important on its own, just on its own. And I said some aspects of Pillar 2, we have to widen that certain aspect of our Pillar 2 regulation. That's speaking from a regulator's perspective. Now you can take a cue from that. For example, I mentioned the issue of stress testing and scenario analysis. All right. So if your organization can begin to look inward to try to come up with a kind of internal policy document that would mandate not just develop a policy document that sits in a shelf somewhere in the manager's office, but a kind of policy document that drives action, whereby you do a kind of periodic scenario analysis, stress testing. This will go a long way in helping you to address these emerging risks, especially this one on cyber security. Of course, so many banks, if you visit any banks today, they come up and say, "Oh, I have a policy on cyber security." Well, for me, that's a characteristics. It does not. It doesn't equate performance, but how well do you put that in practice? So you need to take a note of that. It is very important, so that how well do you implement? You have to bring it on board. You need to implement regularly. You need to look at take a deeper dive when it comes to scenario analysis, and that will tell you how those your weakest exposure points to cyber risks, and how you can manage that, and how you can keep down your exposure to cyber risks. And so I believe that's a good way for you. But from a regulatory point of view, I mentioned the issue of stress testing. I mentioned the issue of enhancing supervisory judgment. I mentioned the issue of coming up with a kind of committee that look at risks from high up there. That's you look at risks as a matter of prudential issue, not macro issue. So that's from a regulatory perspective. But then you can also take a cue from that one that relates to you, which is stress testing and scenario analysis. It is scenario analysis has no boundaries. It all depends on how well you are able to use that and address your risks. Thank you.
Thanks so much. I appreciate it.
Yes, sir. Thank you so much. Next, please.
Dr. Fashipe, you are well appreciated again. So let me just call Alaji, the chairman. Let me see with the chairman. He was still around just a few minutes ago. Right. Maybe the chairman has one or two things to say so that we can. Alaji, sir, please let me just call the chairman. Let me call him privately so that we can just round off this discussion. Thank you so much. God bless.
Yes.
Alaji.
Yes.
Is Mr. Fashipe still speaking?
I'm here, sir. I just addressed the last question.
Let me start with you. On behalf of the AERMP, let me personally, on behalf of the president, the DG, and all the members, appreciate the time you have taken and the detail you have done and the patience in answering all the questions that have been put to you. So we appreciate you very well, and all the participants that have attended today's program. I believe that will go a long way in demonstrating the reason why our institute decided to bring this conference at this time. And the theme of the conference have already been discussed detailed today. And I believe the communique that we are going to come out with will go a long way in supporting the economic plans of the current administration and what we have been doing for us as an association, the Association of Enterprise Risk Management Professionals. So let me, on behalf of all the organizers, appreciate all the people that have attended. I saw so many names today that have patiently been around from the beginning to the end. Still, we have over 53 participants. This is a program that we have started since around 12 o'clock. I can see Professor Mariam still there. I heard about the board of those names. If I say I will continue to mention names, Olariwanjo, Olania, everybody, we want to appreciate you for the time you have taken in participating in this. So, and let me once more congratulate the association officials for convening this important gathering. And I believe the distinguished speakers and all the participants have really learned a lot today from this conference. And I believe that will go a long way for our 2027 conference by God's will. So once more, thank you very much, our president and all the participants and the DG. So on this note, let me thank everybody for participating fully and wish us a fruitful discussions on the ERM going forward. So let me invite Mr. Olayinka, our able president, so that I can conclude. I just say, let me use this opportunity to thank everybody that participated. My president, Mr. Olayinka, you can join him, please. Thank you.
Thank you very much, sir. I appreciate you always, Alaji. God bless you. We really appreciate your leadership at our prestigious NGX, Nigerian Exchange Group. It's a wonderful, wonderful thing. You are the right person that is fit for the job, even as at this time in the history of our nation. God's guidance will never depart from you, and it shall be well with you. Thank you, sir. Thank you, sir. Thank you, sir. Thank you for the support. Thank you for everything. God bless you, really good. Thank you, sir. All right, so I want to appreciate every one of us once again, our dignitaries, every one of them, Right. I really want to appreciate you on behalf of the president, myself as the DG, the president and the chairman of council, Mrs. Ige, Mr. Dame Sylvia Taiwo Ige, fellow of enterprise risk management professionals, and myself and every one of us that are here today, including our director of capacity building, that is Dr. Olusheyi Olubile Eriwusi, the Chief Risk Officer of Providus Unity Bank. I want to appreciate you. I want to appreciate everyone, even including some other risk officers, the chief risk officers that are here, both at the mega bank level, at the microfinance level, at other, and the academia. We have a lot of professors. We have mentioned some of them. We have mentioned, I hope we're able to mention all of them. Thank you once again, right? And a lot of comments that are there, right? As an institute, we are going to sit down and to look at them one by one and to see how we can build capacity around this. And that's the essence of the conference. I want to assure you, by God's grace, even all the output here today, we get to Basel, the bank, the Basel place in Switzerland. All the Bank of International Settlement and all those, all the organs that are responsible for Basel implementation, they must get, all these things that we have suggested. We are going to have a communique. That communique will be written comprehensively. Yes, sir. Thank you, sir. Thank you, sir. So we get it to every regulator. They will know about it because all regulators are part of this. The NDIC,
CBN,
the Central Bank of Nigeria. You understand, right? So all of them will eventually, they communicate. We get to them, their input and all those things, and eventually we will get it across to every one of us. Thank you very much. In fact, and this thing does not end like this. Anything that anybody has, any suggestion, you understand, you can also chip it in. You understand? Our lines are open. We are always there, that kind of thing. You can suggest, to change anything is not only one man's business. You understand? It is the collective effort of everyone. You understand, right? This one, Alhaji, came in, Alhaji Kwaranga, at a very short notice, and he said, this thing must succeed. Alhaji, once again, thank you. Thank you. To God be the glory. So let's, everywhere we are, in the academia, banking, in the capital market, anywhere we are, let us, let everybody, let them know. You understand? Even those who are not here today, let them know that something has happened. Let the communicate, let it reach them. Put it in the social media. These are the kind of things we should be putting in social media, not the things that are dirty, that are negative. But something that nation building, something that is related to institutional capacity building, something that the regulators, financial regulators that would like, even non-financial regulators that everybody will benefit from. Right. So thank you very much once again. I want to say God bless you and thank you. We continue to reach out to you because we have the contact. Thank you and God bless. Thank you. All right, sir.
Bye-bye, everybody. We appreciate it.
Thank you. We thank God. We thank God.
Thank you so much, sir. Bye,
Thank you very much, sir. Thank you very much, sir. God bless you, sir. We appreciate it. Thank you.
Thank you.
Thank you. Thank you. Dr. Fashipe, we say we appreciate you. Thank you.
Thank you, sir. Thank you, sir.
Thank you very much. Thank you very much. We appreciate you. We continue to discussion, the discussion from here, right? So that we meet. Thanks so much. So Kester, Elijah, every one of us, Elijah Aditimeyi, our MD, God bless you. Thank you.
Thank you very much, sir.
Thank you. I hope you are able to gain one or two things from the conference. You understand?
Yes.
And God will continue to protect us even till the next one and beyond. Thank you, Ifeoma, our HOD, for staying till this time. We appreciate you. Oh, our fellow, Mr. Olaniwaju Olaniyan, thank you. God bless you. Olaniwaju Akimade. Oh, Omoleko Phyllis Shanusi from PwC, we want to say thank you. Our Prof. Miriam Abdul, all of you. Ruben Isibo, oh, our fellow, God bless you. God bless you. Tasil, our fellow from the north, from Kano there, we want to say thank you. Thank you. God bless you. Thank you so much. God bless you. Regards to our fellow at home, it is well with you. Thanks so much. God bless you. Thank you. Omire, thank you. Mr. Latif, thank you. Eunice, God bless all of you. Thank you. Oh, Mr. Shesi, Olariwaju, thank you so much. God bless you.
Our professor in the house.
Thank you so much. Be careful. My senior professor, they are in the class. Oh, my teachers are in the class. Oh, that's why by the time they say, is that man competing with us? God bless you. We really appreciate you for joining. Thank you very much.
Thank God.
Thank you very much. Thank you very much. Let's just keep the flag flying. You understand? We will get there by God's grace. We are getting there and we get there. From Ibas, from Abuja, thank you. Thank you so much. So let's spread this thing on the social media. Let people know about it, that a lot of things have happened today. You understand? Thank you. God bless. Bye for now. Till we meet again by God's grace.
Bye-bye, sir. So are they going to send the live this thing?
Definitely.
Thank you for your time and all you do.
Okay,
Thank you. Thank you, Elijah. Thank you. Thank you, Eileen. All right.
Yes, sir. Thank you. Bye-bye.